Good afternoon to all of you. I'm very happy to welcome you for this annual AXA Investor Seminar. We have a lot of people attending in the room, but I think we have a lot of people as well on the webcast. So welcome to all of you. Quick words before we get started. As you know, the day will be focused on our P&C activities. It will be hosted by Jean-Laurent Granier, the CEO of our global P&C business. Jean-Laurent will shortly introduce the presentations of the day for 20 minutes. Then, for those of us in Paris, a lunch will be available next door in the main corridor, and we will reconvene at 1:15 sharp Paris time. Tend to specify that. We will then have 3 presentations. The first one on commercial lines with Jean-Laurent, and Jean-Laurent will be with Amanda Blanc. Amanda is the CEO of our UK commercial lines business, and Philippe Rocard, the CEO of AXA Corporate Solutions. We'll then follow with a presentation of our direct business with Stéphane Guinet. Stéphane is the CEO of AXA Global Direct. And then eventually, after a short break, a presentation of our Asian P&C activities with Gaël Olivier, the CEO in charge of AXA Asia P&C. Each of the 3 presentations will be followed by a Q&A, and Jean-Laurent will host at the end of the day an overall Q&A at around 4 p.m. I wish you all a great day, and hopefully you'll learn a lot about our P&C activities group-wide. I think Jean-Laurent, I can now hand over to you. Thank you.
Thank you, Mathieu, and good morning or good afternoon to all of you. So, a short introduction just to give you an overview of what does P&C business means at AXA, and then we'll move for lunch before going into more details. So first of all, P&C business is for us something very solid, very robust as a business model that has been consistently delivering over time in the last period. It's a growing contributor to the group underlying earnings, with the advantage of being far less financial market sensitive than other ones. So I will present the big picture of the business, then I will explain how we put profitability at the core of our operations, and I will end up explaining how we intend to accelerate through some very carefully selected growth engines at group level. So, in terms of the big picture of the group, 10 years ago we were, let's say, a mid-size player, and AXA has been transformed into one of the largest P&C franchises in the industry. We are ranking number 2 in terms of the number 2 international insurer with 2.6% market share today. We have a combined ratio of 97.6% by the end of 2012, which means that we have a profitable business, accounting now for quite a half of the total earnings of the group. We have a return on equity of 14%, which is already a strong one. So this is for the big picture. We have quite a well-diversified model. We are diversified through geographies. First, we are present, of course, strongly in Europe, but also we are now the number 1 global property casualty insurer in Asia. So this will be one of the focus we will share with you this afternoon. We are as well one of the largest global direct players, and I think it's an extremely strong asset that will be presented by Stéphane in detail this afternoon. We have also a balanced portfolio in terms of product lines. We are carefully selecting the business lines we want to be in because we want them to be profitable, and we have as well one of the largest global large corporation players. It's AXA Corporate Solutions that Philippe Rocard will present this afternoon. And of course, as you all know, we have prominent position in many important markets in P&C. Moving forward, what is the way for us to run that business at AXA? We run this business through what we call a global business line, global P&C business line, which means that we have a common and comprehensive P&C setup encompassing all the operations in the group. The strategy is overseen by a P&C board, which is composed of 12 executives around me, leading and heading all our major P&C operations around the world. All our operations and processes are reviewed through AXA Global P&C, which aims at monitoring value creation and earnings growth and simplifying our industrial model in order to gain in efficiency. We are taking care of people as a critical human capital resource. We are overseeing the professional families at AXA Global P&C, and we are trying to spread our expertise over the whole group with robust HR programs, which aims at training people in the high-growth market, notably, and enabling them to benefit from the strong findings and learnings we had in the major markets we have been in for quite a long time. All this setup allows us to have a stronger and more agile risk management framework. Of course, you probably know that we have an internal reinsurance carrier. AXA Global P&C is also a company, which is this reinsurance carrier, which helps us, which allows us to pool our reinsurance operation and the way we purchase reinsurance in the market. This also leads us to decide to increase our retention on catastrophe reinsurance cover from the previous threshold that was 300 million euros up to 500 million euros now for next year, while of course remaining protected against some major events frequency. At the same time, we are investigating some alternative to this traditional reinsurance market, and we have announced last October having placed a cat bond of 350 million euros, Calypso 2, which is the largest cat bond ever issued in the market. So this is for how we leverage this common and comprehensive setup, notably from a reinsurance point of view. In terms of our track record, I think we have quite a good track record. Of course, we are growing. We have a growing trend in revenues, but we are not prioritizing profitability. We are prioritizing profitability over top-line growth and not compromising on this profitability. We are driving now our combined ratio, now standing at 97.5. It is the figure we have disclosed half year this year, whilst becoming less and less dependent on prior year reserve releases and maintaining a very good and healthy reserve ratio standing around 190% of earned premium. This allows us to have the improvement of the combined ratio you see on the chart, and means that we are on track to deliver on our targets by 2015, which is to have an all-year combined ratio below 96%. This profitability focus we keep on allows us to be delivering constantly strong earnings to the group. Of course, we have to struggle with the low interest rates environment, but we are mitigating this effect through a tight asset liability management and with a short duration gap. And we are smoothing the effect of this decreasing interest rates. Our earnings are growing, and it is important to see that we've been able to reduce volatility from financial market and deliver strongly in the earnings side over time. Our strategy is, of course, fully deriving from our overall Ambition AXA framework. And in a nutshell, it consists in, first, continuously focusing and improving value creation, and second, to select carefully our growth engines. In terms of value creation, of course, we are keeping on focusing on technical excellence, developing technical excellence everywhere in the world, everywhere in the group. We are pricing for a 15% return on equity target. And we are maintaining the efficiency gain momentum since we have started from the launch of Ambition AXA to track those gains year after year. And last but not least, we are now leveraging technology and connectivity as another enabler for gaining in efficiency. So this is overall the strategy, and I will now explain how we put profitability at the core of our operations. First of all, of course, we stick to a very strict pricing discipline. One of the assets that enables us to have this kind of discipline is the fact that we can rely on solid proprietary networks, notably in Western Europe. This allows us to apply a price increase wherever it's necessary without leakage that traditionally we could have with third-party intermediary brokers, for instance. Also, we have inside the group this direct platform. The idea of this direct platform that Stefan will present this afternoon is not only to gain market share in a fast-growing market, but also to use it as a laboratory to test new ideas, new techniques, and then implement them in the traditional business, leveraging those capabilities. That's this way that we have developed some nano-segmentation aspects, competitive market analysis, or behavioral pricing, and it has helped us to sophisticate further our pricing methodology through notably elasticity analysis. You will probably tell me what is our vision in terms of pricing trends. Of course, we have benefited somehow of favorable pricing trends the last 2 or 3 years, and we expect some slowdown. But it's today a mixed picture, and we still see that there are areas for improvement for price increases in some markets, notably, for instance, the household markets in the personal lines segment in Germany, France, or UK. Of course, we are facing fierce competition in some markets as well, such as in UK in motor, or impact of the economic slowdown in Southern Europe. But overall, we have a tight management of those effects. But if I move on, I would say that technical focus goes, in fact, beyond pricing. First of all, we want to have very concrete action in order to have leading technical segmentation in order to sort out what is profitable and what is not. Second, we lead some very active and systematic portfolio review each year with 2 ideas of pruning the bad parts of the portfolio when necessary and reprice every time it's also necessary. In terms of the operation processes and notably the claims management processes, here also we leveraged all the experiences and knowledge we get from our direct platform. It has helped us to efficiently streamline some processes and to implement some new tools, such as, for instance, automatic fraud detection. As well, we are keeping on our focus for increasing the orientation to agreed body repair shop in order to reduce the claims average amount. This allows us to mitigate the claims inflation by around 50 basis points per year. And it translates into a decrease of our current year loss ratio. And since the start of Ambition AXA, we have been improved, as you may see in the right-hand side, by more than 4 points in France, in total, for instance, more than 10 points in Belgium, and around 4 points in Germany. Third point in terms of this efficiency and profitability focus, technology. We want to further enhance this focus thanks to all what technology today enables us to do. In the bottom part of the chart, you can see that in our operation, we are implementing direct consequences of those technological evolution. Real-time algorithm for fraud detection, already mentioned, geolocalization for pricing. I will come back to this one this afternoon, talking about how we monitor the commercial line business. And also natural risk natural perils, and accumulation monitoring in order to better understand and pilot our risk exposure. We have decided to go further, and we've recently set up some new capabilities in order to research and develop new ideas and innovation in order to improve our technical excellence. We have set up a data innovation lab that, of course, will focus on what big data could bring to us, and recently set up as well a digital lab in Silicon Valley. In all those areas, also, we take care to have some innovation available for our customers. On the right, left-hand side, you have all the payout, how you drive, pay as you drive, crash recorder that already we have developed in some geographies such as Italy, UK, or Switzerland. But recently, we have also made available an educational and preventional tool for our customers. It's an app which is called AXA Drive. So if you have this kind of device in Spain, Belgium, or Switzerland, you can download this app that will help us to analyze your driving behavior and have a feedback in real time. So far, we do not collect data, but it's an educational tool that we make available for people. Interesting to know that 260,000 times this app has been downloaded in November. So, how to accelerate? Because having, let's say, decided to stay firm on profitability, we have decided to select what will be our growth engine for the future. First of all, high growth markets. Of course, you all know that we have decided to put a stronger focus in increasing our footprint in the high growth market. Just back in 2007, the high growth market in P&C were only representing 4% of our P&C revenues. It's today 14%. And we have taken some significant additional steps in 2013. First of all, in China, where thanks to the acquisition of 50% of Tianping, we will be the #1 P&C foreign insurer in the country. Second, in Colombia, we have recently announced having acquired 51% of Colpatria Seguros, which is the 4th insurer in the fast-growing Colombian market, but the #2 in P&C with 9% market share. And as you maybe know, since it's sometimes not very well-known market in Europe, Colombia is the 3rd population by the size in Latin America after Brazil and Mexico. And Brazil, I was talking about Brazil, we have recently decided to set up our own operation. It will be a greenfield in order to target the commercial lines market in Brazil. This will start next year. Up to now, we have enjoyed a strong acceleration of the top line, and during the first 3 quarters of this year, we have confirmed having a plus 15% growth in the high growth market in P&C. At the same time, we are driving the improvement of the bottom line. And you can see in the right bottom hand side that we are now making or building around 120 million euros earning in half a year, where it used to be the contribution for a full year in 2009, for instance. I would like to share with you 2 very concrete and precise examples on how we manage the business in those new markets. First of all, Mexico. Mexico is a company we acquired in 2008 from ING. It was a loss-making company with no real internal dynamic. We have made it a market leader with around 15% market share today, and in a 5 years period of time, we have built the AXA brand as a strong brand in the Mexican market. In terms of the figures, the average annual growth of revenues has been 23% over time in the last 4 years, and the combined ratio have been driven down to 97% last year. And you can see that it has become now a solid contributor to the group earnings, and this will go on improving in the times to come. In Turkey, it's another interesting example of growth. There is a very sustainable growth in this market. We are the market leader with 25% market share in motor, and we have a very cost-efficient model with a 23% enlarged expense ratio in Turkey. Not only it is one of the best expense ratio in the group, but it is one of the best enlarged expense ratio for such a company in the world. Of course, we had to reinforce our capabilities and to leverage the professional P&C family across the group in order to face some difficulties in this market. But it's a good example of the quick response we have been able to build in order to follow some rise in the legal claim cost and to tackle the bodily injury issue. If you look at the combined ratio, you can see that from the experience of the first half of the year, we are very much back on track with a 99.4 combined ratio, and we have turned it this year in a very profitable company, still growing the top line. Another growth engine that we have identified this year for the P&C business, which is an additional one, is bancassurance. Yes, it's still quite a small part of our total P&C revenue, standing at 4% of the total, but it has grown quickly the last years, notably 33% last year. And it's an extremely attractive and profitable business with a combined ratio around 90%, which is quite low and showing high profitability. So we have a series of major top-class banking partners across the world. And the idea there is to leverage our know-how, our brand, and to have fruitful partnership in order to accelerate our development globally. Notably, the last important step taken, you have all this in mind, was the acquisition of the HSBC business in Asia and in Mexico. So here we are for this quick overview of what is the P&C business globally at AXA. This afternoon, we will go for more details. First of all, in commercial lines, where I will share the floor with Amanda Blanc and Philippe Rocard. We are the fourth largest player worldwide in commercial lines, and it's already a very strong underlying earning contributors in the group. Then direct, where we are the largest global direct player. Most of them are very local, but we are maybe the first to have built such a global cross-border platform. And the last but not least, Asia, which definitely is one of the places to be in, where we are now the first international P&C insurer, and as you may notice through the combined ratio of 93%, already a very profitable one. So let's break for a quick lunch. Let's resume at 1:15, and thank you for your attention. Welcome back. Hope you enjoyed your lunch. As announced this morning, we will start this afternoon with a presentation of the commercial lines business at AXA, which is one of our growth engines. And this presentation will be divided into three parts. I will cover the first one, presenting what is the commercial lines business at AXA. Next slide, please. And explaining how commercial line is the key building block of our Ambition AXA strategy, and already significant in terms of share of our overall P&C earnings. And second, we will go to a focus on the AXA UK operation with Amanda Blanc, our Chief Executive Officer for Commercial Lines in UK, which will present you a very interesting and disruptive distribution strategy we have to reposition our operation in this market and make it a growing and profitable operation. And third, Philippe Rocard will present AXA Corporate Solutions and explain how we intend to develop further the large corporate business and how to support also our various entities worldwide in that field. So, moving to the first presentation and the global overview, just would like to divide it into three parts, explain what we are in the commercial lines and how important we are and how we are performing. Second, to explain why we think being well positioned to capture growth opportunities. And third, explain that this will never be done at the expense of profitability, and we'll try to focus on profitability and to monitor our exposures and the volatility, the potential volatility of this kind of business. So in terms of big picture and what is our track record in that space, first, let's say that AXA is the number 4 commercial lines insurer in the market, but if you exclude the US market, and you know that it's a market we do not have any appetite for in P&C since it's very much dominated by pure local players and by lawyers. So if you exclude the US, we are number 2 in the commercial line space by the size of the premium. In terms of our track record, we have constantly grown over the last 10 years at 6% average, and we are delivering those days underlying earnings above 1 billion euro per year, which is more than 20% of the total underlying earnings of the AXA Group. In terms of profitability, this activity, this segment, already shows a return on equity which is above 15%. In terms of position we have in the various geographies and line of business, we have a very well diversified geographical footprint and product range, addressing all types of needs. And notably, we are working with all types of enterprises. 2/3 of our business already is done with micro enterprises and SMEs, which is an important segment for the future. So we have well-established position, And those positions are in a market which is an expanding one, which is proposing growing opportunities. Already today, it's nearly a half of the global worldwide P&C market. But this is a growing market for two reasons, with two key drivers. First of all, there is obviously a strong correlation with the overall worldwide economic activity. And when the growth is recovering or accelerating, there is more substance to be insured. Second, the penetration in the high-growth market is increasing fast, starting from a low base. And if you look at what is expected to be the picture in 2015, you will see that we are already taking positions in markets, major markets, that are expecting to grow fast in the commercial lines segment in the future, such as China, Brazil, Mexico, India, or Turkey. And the part of the market which is expected to grow the most is the micro enterprises and SMEs, and it is precisely the part of the market that we are managing well. So, what is our strategy to capture those growth opportunities? It's quite simple, in fact. We intend to accelerate our current business both in the high growth market and selectively in the major markets. And then we want to explore new horizons beyond the current frontiers we have. So moving to the high growth markets, I think that we are already well positioned because, as explained this morning, we have a large footprint, and at AXA, commercial lines business already represents 60% of our P&C revenues in those high growth markets. And we are seeing growing needs in that space in those markets we are in. What are our differentiating factors? We have two kinds of differentiating factors. First of all, we are operating through strong regional hubs. For instance, we have a hub in Singapore for covering the Asian region. Gaël will present the organization of this operation this afternoon. We have a hub in Dubai to cover the Middle East. We have a hub in Morocco to cover Morocco and the West African countries. And second differentiating factors, we have AXA Corporate Solutions as an internal tool in order to leverage the know-how we have on large corporation and also on very specialized lines of business such as the marine business. All this enables us to have a strong technical expertise which is fostered through knowledge sharing and transfer of knowledge from major entities up to high growth markets in order to build some technical edge. If I spend 1 minute on the example of what we do in AXA Gulf, thanks to the platform we have built in Dubai, we are covering 5 countries in the Middle East, the 5 that are listed on the chart. We are sharing the expertise, we are sharing a common platform, we are bringing really a technical edge to this market, being very short time to market in order to develop new offers. And we are in commercial lines, those figures are for commercial lines, increasing very fast both our revenues and our earnings. And we think this rich part of the world being some promising territory for the future. So this is for the high growth. If I move now to major markets, of course, those markets are very competitive, sometimes saturated, and overall doesn't show a lot of growth. But we think that in some segment of the commercial lines, we can grow further. Thanks to notably one of our assets, which is the strong position we have in proprietary distribution with our tied agents networks, such as the ones we have in France, Germany, Switzerland, of Spain or Italy, for instance. The idea is there to segment the distribution, to select the one agents that are able to sell standardized P&C commercial line products, to train them, and to have a specific and dedicated animation of this segment. In France, it has been implemented successfully. 1/3 of the agents, it is shown in the right-hand part of the chart, 1/3 of the French agents are now part of this segment, and they are clustered by stage of maturity and development. And as a result, you can see that the business brought by the agents has constantly grown over the last years. We have very demanding targets for them, and we are imposing them to, for instance, triple their new business in the micro-enterprise segment in order to keep the qualification. So leveraging the strong position we have in proprietary network is a way to develop further in commercial lines in those European markets. In terms of offer now, we are defining some specific segmented offers for tackling specific needs of our customers. In the middle of the chart, you have some examples of the specific offers we have developed for customers in various industrial spaces, food and drink, hotel, education, whatever. These segmented offers are developed from the knowledge we have of the major market, but are then likely to be implemented and rolled out in the other high-growth market we are in. Also, this approach allows us to develop some niches offer for emerging needs we see in the market. For instance, renewable energies or cyber risk, which are in fact emerging needs and emerging guarantees. And we are preparing the next step, the next generation of segmented offers in order to remain relevant and accurate in tackling the right needs in those markets. For instance, we are those days in Europe launching a startup offer for the new companies that have been recently created. Last point, we have developed AXA International Services for European SMEs. The idea is simple. It's to offer an international coverage for SMEs expanding their activity cross-border. And the idea for them is to access from a unique policy written in a single language, a global coverage of their activities. So this is an example of what we can do in order to accelerate in a segmented way in the major markets. Going beyond our current frontiers, there is more to come, because we want to accelerate this commercial lines development. And we want to invest in some specific growth initiatives. Already this morning, I have commented the way we intend to enter, to conquer to some extent new territories. Colombia, China, and Brazil are extremely significant and important markets for the future that we are entering in this year. At the same time, in the right-hand side, we want to build some new development models. We think that in bank assurance, for instance, there are also opportunities to grow further in the specific commercial line business for SME, benefiting from the strong relationship between the bank and its corporate customers. This is what we do in Italy with Banca Monte dei Paschi, or this is what we start to do with HSBC in the geographies we are partnering. Third idea, we could launch new products. Of course, we already have quite a wide range of products, but we are not covering each and every kind of guarantee. So we are those days studying how to launch agriculture insurance through parametric and index guarantees, and how to develop further the surety business, leveraging the experience we have, for instance, in Switzerland. Last but not least, we want to have a complementary coverage between what we do locally from our local operation and what we are able to do with AXA Corporate Solutions for large entities, making sure that there is no gap between the enterprises that are covered by the one or the other one. So this is, beyond current frontiers, what we intend to do in terms of further developing. But this, as already said, will not be done at the expense of putting at risk our profitability. And we want to monitor, at the same time, profitability and specifically exposures. The name of the game there is sticking to a strict underwriting discipline. For this, we have at AXA defined a process that we call PMP, Portfolio Management Process. What is the idea? Basically, it's to embark overall all the organization in a systematic yearly portfolio review of the commercial lines activity. It's to improve the technical segmentation level we do in the entity for the portfolio, and then to have a much closer monitoring of the renewal campaign execution. This allows us to have much precisely defined growth and profitability objectives segment by segment in all geographies. This portfolio management process has now been rolled out in 90% of our P&C entities, and we will be at 100% in 1 year from now. As a result, you can see the trend in terms of the loss ratio. We have improved by 3 points our loss ratio over the last 3 years. And if you ask me what are the trends we see in this specific commercial line space for the near future, I would tell you that we will keep on increasing prices wherever it's needed from a risk standpoint, because we think that it is the right price of the risk. And notably in lines such as property in Germany or in Southern Europe, such as construction in France, such as employers' liability in UK, we think that there are room for improvement in terms of technical profitability, and we think that we will be keeping on rising prices in those areas. I would like to give you another example on the way we take care of volatility this time. Of course, the first way of taking care of volatility for an insurer is to ensure a good diversification of his risk. And we think that thanks to our scale, thanks to our footprint, we are quite well diversified. But second, we can leverage technology in order to better underwrite, and notably to geo-underwrite and price with regards to risk exposure. So this is a two-step approach. First of all, we are geo-segmenting our risk. And for this, we are acquiring data. We are systematically using perils customized heat maps. We are enriching our database about risk. And we are systematically using geo-segmented approach for all the guarantees we cover. So this is about data and organizing the data. Then, second step, we implement this geolocalization directly at underwriting. We take into account precise long lat and altitude, and we have a proactive control of our accumulations. I just would like to share with you one example of what it means. This is an illustration, this is an illustrative example of how we assess the exposure in case of explosion or earthquake in a urban business area of a European capital. Depending on the severity of the explosion, depending on the location, we have the modelization of the potential loss growth, the potential loss growth of reinsurance. And we are now able to assess and to map all those potential losses and to integrate this into the underwriting process. And this kind of tool can be upgraded from monolocation, from scenario integrated monolocation explosion or earthquake to scenario integrated multi-location. I think this is a good example of how to leverage technology and notably available data in order to first evolve our underwriting process and second, build a technical edge and a competitive advantage for the future. And probably that thanks to the R&D capabilities that we are setting up those days, we'll be able to improve further with the big data thing. So that's it for this introduction. I would like just to resume saying, to wrap up, saying that definitely we think that commercial lines is an area for specialized insurers. We think that we have at AXA a competitive advantage, and we ambition to grow further and to build growing earnings in that field whilst monitoring volatility. So now, let's focus on UK. We leave the floor to Amanda Blanc. Thank you, Amanda, to take the floor. That will explain you how to change and monitor distribution and product mix in order to develop profitably. Thank you.
Okay, good afternoon, everyone. In 2011, I was delighted to return to AXA after 6 years as the CEO of the UK's largest SME broker. So the challenge of coming back to AXA Commercial with a knowledge of both manufacturing and distribution was one which obviously I could not pass up. Firstly, what I'd like to do this afternoon is just to describe to you the business that I inherited at the beginning of 2011, just to give you some sort of context to the strategy that we've put in place. In the previous 3 years, revenues had declined by 30%, and profitability, as you can see here, was extremely volatile. But it was a business with some very unique strengths, and the underperformance was actually areas that were, I believe, could easily be corrected and that could put the UK back in a very strong position. Some of the main issues, though, that had led to this performance were the UK had moved into what we call managing general agent business. That is effectively where you hand control of your underwriting to a broker. And that's bad for lots of reasons. One, for control, but obviously you end up having to pay more commission also. This focus on MGAs had caused a large growth in the business, but it also led to profitability issues. It had also led to us disenfranchising many of the brokers who we had previously relied on for some profitable or very profitable SME business. Now, in the UK, broking is very much a cottage industry. There are 3,000 brokers in the UK, and they control 92% of the commercial lines market. In addition, we had adopted a strategy of taking authority away from local branch underwriters across the UK and moved it into a centralised operation. We'd closed branches, and therefore we'd caused upset to individual broker segments, and it had sought for them to seek alternative markets. In the UK, undoubtedly profitable business is placed with insurers who support brokers locally, and as a result, AXA was limiting its access to profitable business, and it actually led to anti-selection of business against AXA. And I know this from my own experience of having run a broker. The organisation was complex, inefficient, slow to make decisions, as businesses usually are when they're centralised. It had lost focus on its core SME specialism. And finally, it had, during the mid-part of the 2000s, bought some brokers in the UK, bought some distribution. But this unique place was not being capitalised and not being leveraged. And we own a broker called Bluefin, who is in the top 3 SME brokers in the UK. However, it wasn't all bad. There were great strengths in the infrastructure, and there was a very, very strong foundation, which was, I believe, unique to AXA. The AXA brand in the UK is very strong. It would sit alongside the Aviva and Allianz brand, and this is an important brand for a broker to place business with. The claim service was excellent and recognised as market leading, and that's pretty important to be there when a claim happens. There was an existing branch network which provided access to the key regional brokers. It also had an existing commercial direct business, again, fairly unique to businesses in the UK. And this provided us with the opportunity to think about what we could do in this direct-to-consumer market. Also, the ownership of Bluefin, the distribution ownership, was in itself unique. And most importantly, the underlying SME portfolio was profitable. So what was going to be our answer to this dilemma? Given the position of the business and the emerging trends, the chosen strategy was one of distribution, a focus on the SME segment and developing a multi-channel proposition. At the beginning of 2011, we found ourselves in a position where the economy continued to look weak and pricing cycles were becoming longer and shallower. Therefore, we could not rely on external factors to help with the strategy. We also saw an increasing commoditisation of micro SMEs. Here we're talking about the 1 to 2 employee businesses, effectively Facebook generation, new entrepreneurs. We saw that generation was looking for more online quotes, and over 180,000 businesses were searching for commercial direct business online every month. And they weren't naturally seeking out brokers for very simple insurance needs. Therefore, I further believed that an insurer which could execute the most effective distribution strategy to reach these different segments would be best placed to maximise profit from them. To this end, we needed to develop a digital approach to the micro SME segment and take a retail outlook on that market. However, we must also continue to recognise the distribution strength of brokers. They still controlled most of the market. So effectively, the trends identified imply that profitability and competitive advantage in the SME market would derive from 3 broad areas: low cost for micro and very small segments, a reinforcing of the local branch network, being close to the brokers that we were trading with, and creating additional value from the broker that we owned, Bluefin. So as a result, we developed a strategy, and it had 4 strategic priorities. It was multi-channel, and it was distribution-focused. The first part of the strategy was to invest in commercial direct, recognising, as I described earlier, the increasing demand for direct products in the SME market. To exploit these trends, we were going to invest in new digital capabilities. We were really fortunate that we were able to leverage the Swift cover, the direct motor platform, and build our SME products on that, using new product development and digital marketing skills. We were able to create a market-leading online proposition. We would also create a unique model because we would be able to blend this online proposition with the offline proposition, a telephone-based team, but also the ability to provide advice to customers through the ownership of Bluefin. Again, recognising the increased commoditisation of smaller business, so that is the smaller business that the broker deals with, we came up with an idea called Simple. Effectively, we would create a new digital platform for brokers to trade the low premium and high volume business, making it far more efficient for AXA and brokers to trade. Our USP would be to develop bespoke products for this channel. So effectively, we wouldn't take a manual product and put it online. We would start again. All the documents and records would be accessible for the broker, and the ambition was for 80% of the risks to be straight through processed by the broker without the need for AXA to touch. Behind both of these new models, we've developed a single, new underwriting and pricing team with retail techniques not previously deployed in the commercial market, allowing for real-time pricing, a centre of excellence to develop strategies to exploit big data. We therefore have IT, pricing, underwriting, ops, all sitting side by side. Complex SME, which is the third part of the strategy, is our core business. That accounts for 80% of the revenues and, put simply, requires an underwriter to assess each risk. This was traded through the strong branch network. However, we really needed to do some basic delayering and empowering of that organisation to aid decision-making and controls. We needed to build or rebuild local broker relationships by putting trading decision makers at the front of the business. We would expand the branch network and open new branches. We would also target higher growth rates with regional brokers, with lower commission aspirations and more profitable clients. And finally, we would invest in a centralised centre to service smaller brokers to embed a local trading philosophy in order to retain stronger broker relationships. Simply put, our proposition to brokers would be to help them to grow their business or grow their people, and that was going to be our strapline. And finally, we would repair profitability in Bluefin by stabling client volumes, increasing revenues and reducing expenses, and increasing the share of business that came to AXA. So that was what the plan was. And these are some of the numbers. So the 4-year plan was to grow revenues by 50% to 1.2 billion, and reduce the combined ratio by 11% to 95%. So it was a bit of a challenge. The strategies were obviously about improving operational and distribution efficiency. The quality of the portfolio was not the issue. The loss ratio was not the issue. The challenge was to lower the acquisition costs. If we could achieve growth by recognising the distribution channels, we believed that we could make this work. Volume would come from increasing market share and taking business away from our main competitors. Therefore, we needed to design and deploy relevant and market-leading products and propositions. So profitability improvements would come from exiting the high commission and unprofitable MGA arrangements, reducing overall commissions through a series of renegotiations, targeting growth through lower commission regional brokers, and growing volume through the low-cost models. Importantly, we had to do all this while keeping expenses fixed. Enhancing the underwriting controls through better management and information around new and renewal business underpinned this whole strategy. So the result was that we would reduce commission by 5%, 4 points from the expense dilution, and 1 point from changing the business mix. So how have we done? I'm pleased to say that we've actually made excellent progress against each of those 4 areas. To just pick up a couple of the points. In the direct channel, we've written over 50,000 new policies. We've launched 5 new products online, and we really see that the trend for direct online is increasing as we thought it would, and it's actually a very new and exciting area. And we have actually won some awards for some of the websites that we've created there. We've created an online wizard, which means that somebody who isn't expert in understanding what their insurance needs are is able to do that in a very straightforward way, and this has had a great response from customers. In the simple space, we've built lots of new products, brand new products which are easy for the broker to use. This has meant that we've been able to grow that business in a very, very cost-effective way And actually here, we are helped by our competitors also doing the same thing so that the broker actually has an e-commerce comparison so that they're able to actually get best value for their customer. That's actually very, very important in this market. In complex, we've done very basic things right. We've got very, very close to our customers. We've opened 3 new branches, so we now have 11 branches. We've spent a lot of time understanding the needs of our brokers and building our propositions around those needs. And we've empowered the local branches to make decisions in their local trading areas. I can't stress enough how important that is if you are going to obtain profitable business. And finally, as far as Bluefin is concerned, we've doubled the profitability within Bluefin by doing some relatively simple things around cost and also around non-risk income. And that, again, is a success story. So I would say it's a little bit like a football game. We're halfway through the turnaround, and at half-time, we're doing okay. The hard work has paid off. We've encountered 10 consecutive quarters of growth. The business has grown by 21% since 2010 in what we know in the UK is a flat market, one in which many of our competitors have failed to grow at all. As noted, the growth has come from all channels. We've done what many thought was impossible and also delivered a sustainable improvement in profitability. Throughout the period, we've restructured and improved the efficiency of the organisation, realising £20 million of expense savings. We recruited an almost brand new management team that have executed the strategy with great expertise, whilst demonstrating great leadership qualities and great relationships with brokers. And there has been a true team effort. It is now a trading and distribution focused business, which is inherently conscious of profitability and underwriting discipline. Finally, and most importantly, we've regained our reputation for quality of service with our brokers and our end customers. And we've won multiple accolades and have also been called by Data Monitor the insurer to watch in 2013. They also said the same thing in 2012. So at the halfway stage, we've done what we said we would do. We've delivered the planned growth and profitability improvements. And although it won't be easy, I think the business is in great shape for the challenge of the next 2 years. So if I was to ask to summarise what would be the key things that we're focused on for the next 2 years, it's really relatively straightforward. Consistency is really important. Brokers, customers really dislike it when insurance companies change their strategies constantly. And they do punish you for that. So consistently pushing this strategy is really important, doing what we said we would do, evolving the strategy but not changing it, providing stability to the brokers and to our own people. Distribution remains at the heart of the strategy. It is so important that we recognise the new distribution trends, such as digital and direct, but also work with what we know is the dominant distribution channel in the UK, which are brokers. Efficiency is key. We will not achieve the numbers without delivering the efficiency improvements. This comes through the digital opportunities that we have and giving our people the opportunity to write business, but actually without increasing the costs of the business. We're not heavily reliant on the market, but we do require rates to increase in the employer's liability line. Jean-Laurent talked about that earlier. Employer's liability in the UK is a particular issue, and at the moment we have an issue with historic deafness claims. This is nothing to do with business that's being written today, but business that was written many years ago. And finally, segmentation. We must become more specialised. I think that's really important. We know that those insurers that have unique specialisms do actually get a better profitability result. And finally, how can AXA take advantage of what has been achieved in the UK business? Well, I'm actually pretty honoured to have been asked to sponsor a new global initiative which aims to accelerate the growth of SME business across the AXA community. We'll take a holistic view across the value chain to see what activities that have been deployed in the UK and that I've outlined here today can be deployed elsewhere within the group. Focusing on SME, the segment and distribution in particular, focusing on the strengthening of broker propositions, on developing new digital trading channels, reusing what has been done wherever possible, and improving the professionalism and trading expertise across the group. We intend to launch this in Q1 2014 with the support of Jean-Laurent's team, and I have no doubt that working together on this, the AXA Group will realise significant benefits. Thank you for your attention. I'm now going to hand over to Philippe Rocard, CEO of AXA Corporate Solutions.
Good afternoon, ladies and gentlemen. I have worked for AXA Group for more than 14 years and at the head of AXA Corporate Solutions for the last 4 years. What is AXA Corporate Solutions? It's the entity dedicated to the global corporate segment and to the specialties like marine, where we are working, for example, with 25% of the commercial trade ships in the world, or in aviation, where we are working with 90% of the airlines companies. AXA Corporate Solutions was created at the end of the 90s to regroup all the expertise which was spread all over the group to better serve this segment of the corporate businesses. We were the first group to dedicate a subsidiary to this segment, and since that day, we have been copied by several competitors, including one large Italian group at the beginning of this year. Our DNA is to provide international programs to global corporate clients. We offer them the same cover on the same conditions for all their plans or all their liabilities all over the world. And to do it, it's not so easy. We issue a master policy in the country of the mother company, and to be compliant with all the regulations, all the local regulation, we issue as many local policies as the number of countries where the client is active. On these local policies, sometimes it could be more than 150 for one program, mirror the master policy. With this main activity, we are working with 2/3 of all Western Europe global companies. And our growth in the last decade has been strong at 4% per year, despite the last years of economic crisis, and as our business is directly linked with the activity of our clients, and the premiums are often proportionally based on their turnover. So this strong growth has been achieved while maintaining a less volatile combined ratio than the market. The graph shows the evolution of our combined ratio in the red line compared to 2 of our main European competitors. And to achieve this low volatility, we obviously have a strict underwriting discipline, as it was mentioned by Jean-Laurent Garnier, and appropriate reinsurance. And in addition, we have developed a systematic strategy of share. What do we call a strategy of share? In front of a large risk with high exposures, billion euros, high insured values, one of the most important questions is what share of the risk you will take. And there are 2 options. The usual way, which is mainly to leave the choice to your underwriters, and they will decide according to their own criteria, which could depend, unfortunately, on the quality of the last discussion with the broker. Or other option, you define the share with actuarial tools. We have chosen the second option, and our actuarial tools give to the underwriters the optimal share, where you decrease the volatility of the portfolio, and the maximum share, above which you will increase the volatility of your portfolio. And to illustrate it, take the blue curve on the right end of the graph. This blue curve could be the curve of power gen industry producing electricity in a few plants with very high exposures. There, you can't take more than 20% if you don't want to increase the volatility of your portfolio. And we can look to the yellow-orange curve, and it could be a retailer with many shops all around the world, and the risk is already diversified by itself. And there, you can take 100% of the risk and reduce the volatility of your portfolio. So we have developed these types of tools, these actuarial tools, for all relevant lines of business. And as an example, you can see on the bar chart in bottom left, the property case, where the share of the large claims in the last year, above 30 million, for example, the claims above 30 million have decreased by 9 points. So this systematic approach, which is at the forefront of the industry, has contributed to our strong profitability. The total of our underlying earnings for the last 10 years reached more than 1 billion euro. And for the last 4 years, a return on equity above 15%. More than 90% of these earnings were remitted to the group as dividends. And for the future, our ambition is to accelerate our growth by expanding in new territories, new segments, new products, and at the same time to defend our accounts by improving the quality of service. And this expertise we develop can be leveraged on by local AXA subsidiaries working in commercial lines. So to illustrate the new markets, we can start with our footprint. AXA Corporate Solutions is today active in 18 countries, and we will continue to expand in countries like Brazil, where we will enter next year with a large team of underwriters, and we will use this large team as a hub to access Latin American markets. In terms of product, let's take only one example, the cyber. After many cyber attacks from hackers, a lot of risk managers, our clients, want to be protected for the consequences of business interruption if the IT system is blocked, or for their liability if there is a breach of data privacy for their own clients. And with our new cyber product, launched in September, we are able to answer to their expectations. But new market does not mean only insurance. It means also new services. In the last years, the risk managers have seen their role increased in their companies to better map the risk and to mitigate these risks. But at the same time, at least in the manufacturing industry, their staff has generally decreased. So they need to find external competencies, and we have developed a strong team of consultants to help them and created a dedicated subsidiary named AXA Matrix Risk Consultants to take care of them. And all these tools are available for AXA subsidiaries. In some countries, to tap into new markets, we have launched common platforms of underwriters to join the forces, the local knowledge of the market by the local entity, and the global expertise of AXA Corporate Solutions. And for example, this year, we launched a common hull and machinery platform in Singapore to target the marine Asian business, which is growing very quickly. In other countries, AXA CS will stay behind the scene and will provide expertise and capacity to local entities, like in environmental impairment liability for Latin countries, or in DNO, directors and officers, for Western Europe countries. And our platform is also available for services. For example, 1 out of 4 SMEs in Western Europe has a business outside its domestic country. Until 2 years ago, local entities of AXA had no possibility to follow their SME clients outside of their boundaries. Now, they are able to use the AXA CS international network to accompany their clients all over the world. Another example is given with AXA Fine Art, which is focusing on high net worth individuals to cover their leisure crafts, private jets, mansions in several countries. And with AXA CS, now AXA Fine Art will be able to insure this type of client with international policies wherever their assets are. So, in conclusion and in a nutshell, AXA CS is a strong and steady contributor to AXA underlying earnings. It's also a growth engine across the world for corporate segment, and maybe more important, a platform to be leveraged on by local entities for SME business. So thank you for your attention.
So thank you, Philippe. Thank you, Philippe. We now move to the Q&A session for the first presentation of commercial lines. We'll have one Q&A session for each presentation then afterwards. So we are at your disposal.
It's Nick Holmes at SocGen. I actually wanted to ask about the expense ratio at the group P&C level rather than just commercial lines. I was just interested, Jean-Laurent, in your view of where the expense ratio is going to go. I mean, obviously there's a lot of work that's been done successfully on loss ratio, and there is also a lot of work that's been done on reducing expenses, but we haven't yet seen the expense ratio coming down in the way that might be expected. And I wondered if you could possibly explain why that hasn't happened and where you see the expense ratio going in the next few years? Thank you.
It's a great question. So I tried to answer you, showing the way we have already gone down the road. So first of all, not all the explanation you have just had were on the loss ratio. For instance, Amanda precisely explained you that what was at the core of the UK strategy was precisely to drive down the expense ratio in that space. But taking the point at the group level, I would say that since we have started our Ambition AXA journey in 2010, we have moved the expense ratio back from 32.6% down to 31.2 last year. So which means that already you have seen some improvement, around 1.5 points of enlarged expense ratio improvement since the beginning. So we are keeping on the momentum, and we are, let's say, in each year reporting on the progresses we make against our objective in terms of expense reduction. So we are really sticking to our trajectory. We have explained that we had 1.7 billion of expense savings to deliver. We are well on track for this. There are a lot of initiatives that are at work all around the group. And yes, it's not easy, notably in our major countries, but I think that we are trying to, let's say, leverage all the potential opportunities, including technology, in order to streamline our processes and in order to reduce our costs. So we are very aggressive in that space. And I mentioned also the fact that we have some best practices at group level. I took the example of Turkey this morning. We have a 23% enlarged expense ratio in this fast-growing entity. So it's the same kind of ratio we have in AXA Gulf, for instance. So notably, we have some very good, let's say, internal benchmark in order to develop further.
Jean-Laurent, just to be clear, you were talking about enlarged expense ratio. The numbers you quoted were about enlarged expense ratio, not only expense ratio, so including claims handling costs.
Yes, excuse me, yes. I carefully said enlarged expense ratio, including claims management expenses. If I was talking about expense ratio, excluding the claims management cost, we started at 27.8 in 2010, and we were by the end of 2012 at 26.8, and half year 26.2 this year. So this is for the expense ratio in the current exception, excluding the cost handling, the claims handling cost.
And sorry, just to follow up on that, do you have an expense ratio at the group P&C level that you would think of as a good target for your business mix? I mean, I know you've outlined very clearly the absolute value of expense reductions, but I just wondered if, maybe you don't think an expense ratio is particularly meaningful, but that's my question. Should we be thinking in terms of an expense ratio that you're looking to achieve?
I think an expense ratio is very meaningful on a market-by-market basis. And in all our markets, we are carefully monitoring the progresses we make in terms of improving the expense ratio. And the improvement we expect to get are embedded into the target we have disclosed in terms of being below 96% of combined ratio by the end of 2015. So it is really what we want to stick to.
Excuse me. Hi there, Farouk Hani from Citi. I've got two questions, please. You present a picture in commercial lines generally of some pretty strong growth prospects. I mean, you've shown particular examples, but the top lines have been 6% per annum. It's not a segment, of your business that we talk about a lot with AXA generally as investors. So, could you just give us a picture of, do you really think that kind of top line growth could continue outside of just high growth markets, without sacrificing on price? So kind of, again, to reinforce what's going to continue that, what we're missing there. And the second question was, you use a lot of these terms in the presentation, which I wasn't quite clear about, such as geo-localization, geo-segmentation. Those seem, forgive me, those seem quite obvious. I mean, that you have a kind of a central model, but that you look locally at local risks. I mean, what's differentiated about that? Thank you.
Okay, thank you. These are two great questions. I will answer the first one, and I will ask my colleagues, Amanda and Philippe, to complement and to answer the second one, if you don't mind. For the first one, yes, we see some opportunities to grow further the top line in terms of the commercial line business. Of course, I can say the contrary. This will be largely dependent on the overall economic condition. The more we will see growth in the market we are in, the more we'll be able to grow the top line in that field. But this being said, Amanda showed you that even in the UK market, which is a very competitive one, and inside Europe, which means not the most dynamic area in terms of economic growth, we are able to grow the business. So far, what we have disclosed for the first 9 months of this year is a growth of 4% in our commercial line business. And inside those 4%, you have 16% growth in the high growth market on the commercial line side. What is important to highlight is that the first business which is developing in the high growth territories is the commercial lines business, because these are the first customers that are aware that they need to be insured and they need to protect their business. So it's a strong business driver in those areas. And having entered this year China, the way we explain, and you will get more details about China in the two following presentation, having decided to enter Brazil as well and to be more present in Latin America thanks to the setup that AXA Corporate Solutions will organize there, I think that we will have some additional ways of growing the business. This is also why and it's not, I agree with you, an angle which is very usually presented, why we decided to focus on the commercial line business in order to show that there are segments and there are emerging needs that will be growing, including in the major markets. That's why overall, as already mentioned, we have 4% growth by the first quarter of this year. And we hope that thanks to our large scale and the new territories we are entering, we'll be able to maintain and even to accelerate the pace. Once again, it's difficult to say more because we are largely depending on economic condition, even more than in other insurance sectors. But really, it's something that we are carefully monitoring. In terms of your second question, would like Amanda and Philippe to illustrate what is this geolocalization tool and strategy we have.
So I think you said it sounds like it was obvious, and of course it does sound like it would be an obvious thing to have. However, sometimes the most obvious things are not always available, and there are many insurers in the UK that do not have the capability to assess their exposure. And so, for example, when we had the riots in the UK 2 years ago, we were able to use some of these geocoding tools to identify what our exposures were street by street, effectively road by road, and then we were able to actually use that as a tool to go in and use risk management techniques and go in and speak to clients, give them advice on what they should be doing, and also manage claims in a more cost-effective way because it was more targeted. Many insurers had to wait for weeks for claim forms to come in or to find out where they actually had the exposure. So it may seem obvious, it's not always the case.
And this type of tool was developed in the recent years, and it's still developing a lot in terms of quality of the mapping of the risk, study of the risk. And this is not only a tool which enables you to have an accumulation measure, how much will you have if there is an event in this region, but it's also a tool which can be used to price, for example, a SME business. If it's along a river, which distance, etc., you could have it through the maps, and you are able to have a better pricing. So it's not only a tool to measure the accumulation, it's also now a tool to price, and there are still many improvements which could be done in the next year. And we work at the level of AXA Group to define some internal maps to be more efficient, more accurate in our analysis of the risk in some regions of the world, and we do it together because it is shared after that by all the entities working in these areas.
Know your customer, so know your risk and also know the localization of your customers.
Oliver Steele at Deutsche Bank. I've got two questions. The first is, I think earlier on you said you priced across your P&C business to earn a 15% return. You're generating a 14% return overall, and you've said more than 15% in commercial. Apologies, this is actually a question about personal lines. So what do you have to do on the personal lines side to improve that return up to the 15% target? So that's question one. The second question is on AXA Corporate Solutions. In addition to the growth you've achieved, you've also actually reduced the combined ratio over the last few years. In fact, it's quite noticeable. You haven't talked about pricing trends at all there. So I'm just wondering, to what extent is that pricing, to what extent is that driven by your own actions, and how should we think about that going forwards?
So I will answer the first one and leave the second one to Philippe. First one, it's not only about improving the retail business, it's improving all the various segments of the business. Yes, we are already above 15% in the commercial line business, but it is also a business which requires more capital. So we have more to remunerate, and we need to improve even that space. In terms of the retail business, we have already decent performances, but what we have to do is to gain further in efficiency. And I think that the presentation you will have from Stéphane Guinet in 1 minute will explain you how we intend to leverage new capabilities in order to get better processes, to be more efficient in the way we run our operation. And notably, for instance, on the claims management side, we can gain a lot in the loss ratio, both in the loss ratio and in the enlarged expense ratio, thanks to new processes, new tools, and automation of our operations. For instance, we intend to have for a very large share, let's say more than 50% of our claims, a fully automated set of processes in order to reduce our cost and to be much more efficient, paying exactly what we have to pay with less leakage, better fraud detection, and everything. So it's in fine-tuning all the steps of the value chain that we'll be gaining on the retail business and improving further the return on equity. I have to say that what is interesting with the setup we have currently is that we have organized ourselves in order to be able to track the progresses we make in terms of monitoring better each step of the value chain. And I think this is what makes us confident for the future. Philippe?
Yes, for AXA Corporate Solutions, it's true that the combined ratio has been improved in the last year, but in a steady way. And one of the reasons behind is that we have been able to monitor the expenses, and as a matter of fact, they have been flat for the last 3 years in euro, including all the investment we had to do in some countries, which means in the mature markets we were able to reduce the costs, and this was achieved mainly by developing and using now the same platform, IT platform, all over the world for AXA Corporate Solutions. In terms of combined ratio, we're also able to drive the business mix of the company. There are some lines of business where there was a soft market, and maybe there is still, for some of them, a soft market. So there, we did not increase our share of the market. We decreased it, as a matter of fact, and we're able to develop more on some lines of businesses where the price were more hardening. And to look at the future on this, we can see in the pricing trends that the market is very fragmented. There are some geographies, some countries where there are still some increases, like in the US, but in Europe it depends a lot of the type of activity. And in aviation, for example, there is a strong decrease of the rates during at the next renewal. But in other lines of business, for example, in motor, there is also an hardening market. So it's fragmented. It depends of the line of the business, and you have to be able to pilot it and to do your expansion in the lines where it's hardening.
So what I propose you, since we foresee to have another general Q&A session at the end of the meeting, is to break there, to leave the floor to Stéphane Guinet for presenting us the direct business, and then having the Q&A with Stéphane. Thank you. Stéphane?
So I'm Stéphane Guinet, I'm the CEO of AXA Global Direct, and I've been in this position since its creation as a global business unit at the beginning of Ambition AXA 4 years ago. So I'm running direct globally, direct retail. As you may have heard from Amanda, we are also running some other non-retail businesses through direct channels, but my presentation will be focused on AXA Global Direct and direct retail as a whole. I will have two objectives for this afternoon. The first one is to give you an update on where do we stand after 4 years of Ambition AXA in terms of delivering our promise. And my second objective will be to highlight and illustrate how we are now leveraging and utilizing some of the skills, assets, technologies that we are developing as part of Direct to help the rest of the group transform itself into a more digital organization. So let me start maybe with a first slide, which will show you that we have become already one of the largest direct players in the world, if we exclude the US pure players. And as you know, we do not operate in the US. And within the pure, the multi-liner, more traditional insurers, we are clearly far bigger than all of our competition. We operate in 9 countries, nearly 10 if we include China, and I'll give you an update on where we are in China. And altogether, we have generated last year 2.2 billion euro of premium income, of revenues, representing more or less 5 million customers. This is 20% of the total motor retail business of AXA Group. In terms of strategic positioning, we are direct, but we are direct low cost, meaning that we target the most price-sensitive part of the market in each of the markets where we operate. And to do so, as you will see later on, we are almost natively digital company. We are not a digital company in the past. We are mostly telephone-based company, but I will try to illustrate to you that we are on a good track to become a fully digital company. If I move to the next slide, this is what we've been doing over the last few years. We've been growing at 7% across the footprint, when our market was at 1% in terms of weighted average growth. But even more importantly, we managed to become a profitable business. This business was growing in the past already, but had been consistently well above 100%. It was 106, even slightly higher in 2009. And as you can see in this slide, it turned out its first underlying profitable, positive underlying last year in 2012. And in 2013, half year, we are now below 100% in current year combined ratio. And if I exclude the UK, which is still in a turnaround situation, I will give you an update on it, UK Direct, we are even now already below 98% in current year combined ratio. In terms of perspective, we confirm that we target and we will achieve 97 current year combined ratio by 2015, which will represent 140 million euro of underlying earnings, which will be 200 million euro more from the starting point. And our growth prospects are somewhere between 7 and 12%, because as even if we are a growth engine, profitability is first, so we'll optimize our growth under profitability constraints. How do we do this? Quite simply, at the end of the day, it's all about execution, because the strategy that you see is exactly the same line by line from the one that was presented a couple of years ago. We are a technology-driven business and a data-driven business. So let me highlight these 3 pillars. The first one is around pricing and technical sophistication. The second one is about what we call customer intelligence and acquisition. And the third one is around being a low-cost model, a low-cost operating model. Because in this business, if we are not low-cost, it's almost a prerequisite, just the right to exist. So let me now maybe focus rapidly on each of these 3 pillars. The first one on pricing sophistication is just a basic enabler to profitable growth. If you are not sophisticated in pricing in this business, like in all businesses, but even more in our part of the market, you cannot survive, or you can grow, but you can grow at a loss. So the first thing we've done with the team some years ago was to simplify our products. Our products were complex. Customers were buying things they did not know they were buying. We had to charge for it. So we really made a full transformation of our offering and our processing around this offering, because our customers are extremely elastic to price. And therefore, if you want to be competitive in pricing, the first thing to do is to make sure that you sell only what they want to buy, and on which they will compare you and challenge you. But then, of course, we've been able to manage and to build what we call ancillary add-ons, options, on which we are able to generate quite substantial margin. And the name of the game is to be very competitive on the core product, and then to be quite good in terms of execution of upselling or cross-selling. And just as an indication, we've been able to grow and multiply by 5 the volume of the so-called ancillaries between 29 and 2012, and I can tell you that the trend is still continuing to be the same. But this is good, but not enough. On top of it, we've been investing heavily, as Jean-Laurent said, on pricing sophistication. We have more than 120 actuaries, PhDs, nuclear physicians within AGD doing modeling, predictive modeling, data, geolocalization, even in our business as well. And we love the data. We master more and more data, and we see that the value is in the data. And we have a unique chance being direct, is that we can collect much more data than in other kind of distribution models. And I can tell you that we do it. We still have huge potential to do it, but I believe with my team that we are now almost best in class in most of the market where we operate in terms of what we call technical pricing. So it's really about understanding precisely and more precisely the cost of the risk that you insure. And this is about using more and more predictive variables and creating more and more, or detecting more and more, let's say, correlation between various variables. And one unique competitive advantage that we are building is that we are a global organization. So whenever one of my Japanese actuaries is finding something in Tokyo, I can tell you that the day after he will call or he will chat with his colleagues elsewhere in the group. And in terms of execution, we are now extremely focused just to make sure that whatever new is found is made available to the rest of the 9 or 10 other countries. The second topic on which we are investing, it's still the beginning of the journey, is what we call behavioral and competitive pricing, because it's not enough to know what is the cost of risk of Stéphane Guinet. I may cost 400 euro, but if the market is at 420, I would be silly to sell the policy at 400. I would better sell it probably at 418 or something like this. So this is about optimizing the margin, either on new business and on renewal. And we are, again, investing quite heavily on these capabilities, leveraging both the web technology, but also the so-called big data topic. If we move to the next slide, it's about what we call customer intelligence and acquisition. It's de facto the use of the web and digital device to interact and connect with our customers. Most of our businesses were historically telephone-based businesses, and they are now, most of them, web-originated businesses. 63% of our total new business last year was transacted through internet. Actually, some of our businesses are already 100% web-originated, and most of them, if not all of them, by 2015 will be web-originated in terms of sales. What it means for us, it means different things. The first thing is that customers are happy because they can transact whenever they want, but it's a win-win game because for us, of course, it's less cost. And therefore, we can reduce our acquisition costs, both marketing costs and call center costs. And we just illustrated that we've been able to decrease by 15% our unit cost per policy between 2010 and 2012, at a time when we were increasing by 13% our total volume of new business, which, all in all, excluding the UK, is over 1.5 million new customers this year. If I move now to the next slide, and I should have maybe started by it, because this is a prerequisite to just play the game in this space. We were starting from a situation where our businesses were not at the expense level where, or enlarged expense level where they should be. So we've been working hard in terms of process efficiency, simplification, technology, convergence of IT platform, time to market, and individual performance management, which is absolutely key. All of our 5,000 employees have clear target in terms of doing tomorrow better than they were doing yesterday. And this has had some positive effect on the global expense ratio figure that you can see on the left-hand side of the slide, both in France, which is a difficult market to reduce costs, but we managed to do it, so it's not impossible, and more globally in continental Europe. On the right-hand side, these are more granular, let's say, KPIs that we are following on a regular basis, but which can show you some indicator of productivity on some of our non-internet, let's say, or fully automatized transaction with customers. So again, process efficiency, convergence of IT platform, both in Europe and in Asia, and individual performance management. Let me now give you a short outlook or maybe slightly more detailed outlook on three of our main markets, which are France, Japan, and Korea. Altogether, as you may have seen, so they represent roughly 55% of our total footprint. Again, all of these figures are excluding China. I'll come back to China in a minute. France, which is our historical flagship, is now performing reasonably well. As you can see, it's been growing substantially over the last few years. It's nearly a €500 million euro business. This year we will have grown at least half year by 15%. And the current year combined ratio of this business is, as you can see, even below our long-term target at 96.6. It's not that we do particular things, it's just that we are implementing systematically all of the points that I mentioned a couple of slides ago. We benefit in this market probably from a slightly stronger brand awareness because we've been in direct business for a long time, plus the fact that we have not a leading market position, but a dominant one. I think we control more than 50% of the direct market. So clearly, we have a model which is now an extremely good platform for future growth. And I will show you in a minute how we now utilize this platform to also help AXA France go and accelerate its own multi-access strategy. AXA Direct Japan is a business that was also started a long time ago as a greenfield by AXA, by my previous colleagues. We are number 2 in Japan. The number 1 is Sony, it's a pure local player. We are growing at market rate, slightly more, 7-8%. But as you can see, this business is extremely profitable. I think we capture nearly 50% of the underwriting margin of this market for direct, and we run at 93 right now. We are looking at accelerating the growth because clearly this level of profitability is almost too much. But again, how did we do this? It's relatively to the market, I think, superior pricing capabilities, even if this market is more regulated than some others, so we cannot do all what we would love to do. On a relative basis, again, I believe we are better than competition in terms of expense, even if in absolute term we are quite above our average expense ratio in other countries. And finally, we enjoy also a bit like in France, quite strong brand awareness because this is one of the markets where we use the AXA brand. And we can leverage the fact that AXA is also very big, actually much bigger than we are in life business. And we have some kind of cross-fertilization marketing impact between our two companies. Plus, we are now successfully cross-selling motor business to AXA Life customers and starting to do the reciprocity. Last is about Korea. Korea is a business that entered the AXA Group more recently through an acquisition 5 or 6 years ago from Kyobo, for those of you who know the Korean market. It's a bit of a tough market, looking like the UK market, extremely competitive, all in all, not profitable. But like in the UK, when you are better than the others, you can make a decent underwriting margin. We are not yet there. We were clearly not there a couple of years ago, as you can see at 108. But we are now generating a positive underlying earning. We are still slightly above 100, but as you can see, just above. And will be shortly below the trigger line. We've been growing only at 2%, which can be slightly small, but in comparison, to the market, it's probably 4 or 5 points higher than this market, because unfortunately, this market, like some of our other markets, is actually currently shrinking. I think it's -2, -3 on a year-to-date basis. And finally, on Korea, we bought a year ago, and the figures are not included, and they are pro forma in terms of percentages in this chart. But we bought Munich Re Ergo business, and we are just finalizing the portfolio transfer of this business, and it went actually pretty well, and will clearly benefit from a scale effect in the coming years. So this was about, 3 of our businesses. Let me now move rapidly to the UK. The UK is a slightly more challenging situation. We are more in a turnaround situation, a bit like what Amanda said before in the retail direct business. Before 2011, we were not, I believe, where we should be, at least to compete in such a competitive market. Our average pricing sophistication was good, but below best practices in the market. Expense ratio was quite acceptable, but again, compared to competition, not at the level where it should be. And I think that our business locally was not good enough in terms of upselling and cross-selling and deriving more value out of an existing customer relationship. So all in all, the profitability was not there. So the management team has been changed, and the new management team is implementing the pillar that you saw some slides before, which are around pricing, sophistication. And I think that a lot of progress have been made over the last 18 months. We are not yet where we ought to be, but we clearly made a step change, I believe, over the last months or years. Claims management is a big topic for the people in the room who are well used to the UK market. So we are also, I think, upgrading our capabilities in terms of especially bodily, but not only claims management processes, both for the fault and not at fault processes. And the team has reduced quite severely its expense ratio through, severe FTE reduction and a zero-based budget, even negative-based budget. So all in all, in terms of figures, the good news is that this business has delivered a positive underlying earning for the first time since a long time ago. It's not yet where it should be. It's clearly shrinking a bit in terms of top line. At a time also where the market as a whole, as you know, is quite soft, so is declining as a market quite sharply as we speak. So that was it for the first part of my presentation, and I hope I convinced you that we are well on track to deliver the promise. There is still potential to be better, and we confirm our 2015 aspiration. Let me now maybe highlight in a few minutes how we are now utilizing some of our assets or skills or teams to also help AXA more globally. Clearly, as Jean-Laurent said, direct is really at the heart of the group digital strategy. To compete on our space, we have to be digital. So we are becoming more and more digital. We have to be extremely sophisticated in terms of pricing and technical management. So we try to do it, and we have to be low cost, so to have renewed, clever processes, automated as much as possible. And these capabilities are capabilities that now we more and more leverage concretely with all of my colleagues, both in P&C, but more globally as part of the digital board of AXA, as part of the P&C board, the retail board of AXA. So we are now more and more concretely cross-fertilizing capabilities. And clearly from AXA, we are also benefiting from a lot of support in risk management, in capital allocation, in HR management, on many other strategic topics. If I now give you an example on this Click and Go AXA France, next page, where on the right-hand side you can see a website, which is the website that is offered under the AXA brand for the so-called Click and Go offer, which is a web offer proposed by AXA France. You can not see it on the right-hand side, but behind the website, you will know, and I will tell you that a lot has been done or co-done or co-developed with our French, AXA Direct French teams, both in terms of technology, web, product, underwriting, pricing criteria, but also claims optimization. One point that I've not mentioned, or that I mentioned too rapidly, is that one of the strategic pillars as part of low-cost operating model that we are developing within AXA Global Direct is clearly on our ability to massify, to channel most or a very, very high proportion of our claims to a very narrow or small set of body shops so that we can derive extremely good good procurement power. So this is an example on how do we cross-fertilize. Jean-Laurent mentioned some other areas where we use some of our expertise in pricing also for some other topics. But let me now maybe to close my presentation, give you a short update on China. You will know that the Chinese market is a big market. It's a 50 billion euro motor market already today. There are, I think, more cars, new cars sold in China than all Europe included, 13 or 14 million per annum. The global motor market in China is expected to grow has been growing and is expected to grow by over 16%. When you look at the direct part of China today, it's roughly 20% of the existing motor market, and it's expecting to grow actually at even a faster pace than the global motor market. So global motor will grow 16, best estimate. Direct within the motor will grow most likely at 30%, 30. So this is the context. If we move to next page, you know that AXA is finalizing a partnership, a 50-50 partnership with a local player called Tianping, which is a fast-growing entrepreneurial business, which was created a couple of years ago. It's really a motor or quasi-motor business today. It was the first one to enter into China, in the Chinese direct market. It's a Chinese player, and it's among the three main ones who have across China, a national, what we call national telemarketing license. So as you can see, it's been growing quite fast over the last few years. And today, direct selling represents 20%. So more or less the market ratio of what this team is willing to do. The good news is that we share exactly the same strategy and the same vision of this market. As far as motor is concerned, we want to become a direct company or to have a very large part of our business which is handled through direct capabilities. To give you figures, we plan with the team to grow up to 80% of our motor premium that will be channeled through direct. Direct means by 2020. And to do so, we will help our Chinese colleagues, again, to implement some of the advanced capabilities that we've been able to develop and that we are developing in other parts of the world. This work has been starting now since a couple of months ago, very positively. And I'm quite optimistic about our collective ability with our new Chinese friends to make the difference in this competitive market. Maybe, a few words. I know that Gael will again highlight some other element on this Chinese acquisition, because we will not only sell motor business, but we also plan to sell non-motor products such as health and personal accident, because there is clearly a market opportunity. And I know that we'll leverage some more global P&C capabilities to help develop commercial business and also leverage the HSBC distribution agreement across China. So thank you very much. I hope I made the point on how we also try as a group with my colleagues to leverage some of our capabilities to help on a broader scale the group to transform into a more digital organization. But I'm very pleased to take any question either on the first part or on the second part. Thank you very much.
Good afternoon. It's Andrew Crean at Autonomous. A couple of questions. Can you tell us what the return on equity is for the whole of your direct business, firstly?
Yeah, I think it's currently around 12%, and it's planned to be at 14% next year. I'm talking under the control of my CFO in the room. But yeah, roughly speaking, this figure, 14% next year, 12% this year.
Okay, so you've got 1.2 billion of premium, you're making 40 million. And how does
2.2
that,
billion, not 1.2.
no, in the half year.
Yeah, sorry.
So you must have a very small amount of capital dedicated to the business if it's 12%.
That's true.
Is it what?
I mean, this business is quite short tail, as you know. I mean, it's mostly a motor business. It's quite short tail and it's quite well diversified, all in all, because as you can see, we operate in many countries. So yes, it's not that capital intensive as a business. Actually, it has quite a low capital intensity.
Second question is on Swift cover, which is a quarter of the direct premiums, and I think those of us in the UK have watched your development of that business over time with increasing scepticism. You're always the cheapest in the market. You didn't ask that many questions, and it now looks as though the business is, up for being reorganised. We're at a point in time where profitability in the UK, which is a cyclical market, is at a peak, and you're making, I think, 10 million. We are seeing price cuts which are likely to lead a very cyclical market down. Why do you think you can make any real money in this market? And does that have any implications for your overall direct strategy and the faith one should have in it?
Yeah, I don't believe that the market is at its peak at all in terms of its profitability. I mean, from a previous year perspective, some of our competitors have accumulated additional reserves that, and we are not able to do it for the reason that you mentioned. So we are not releasing previous year reserve. But if you look on a more current year basis, the market is extremely soft. So the market is suffering, prices are decreasing. So I'm not sure that the market as it is today is at its best moment. And we expect some kind of positive cycle turning down in a couple of months or quarters, most likely. I do share the view that we are not where we should be in terms of pricing sophistication. And this is the first point I made. So we have put a lot of focus this year and last year to really make sure that we get close, if not at par, with the best player in the market. And I think we are reaching, or we are narrowing the gap very, very rapidly. In terms of my personal belief on our long-term profitability prospect in the market, I think that, the more liquid, the more competitive the market are, the better it is if you are the best. We are not the best in terms of capabilities, but the best player in the market is deriving from this market abnormal, over average, well over average return. So for us, direct part of AXA, having extremely competitive and liquid markets is actually a good news. We just need to make sure that we are top quartile in terms of of operating model and capabilities. But for us, it's good news. So the more rapid the market are becoming liquid and competitive, the more we can leverage increasing return out of our competitive advantage. I don't know if it does answer your question. And I think the French example is a very good example. We are able to derive extremely healthy combined ratio while growing very fast. And I think that this is something that we will see more and more across our footprint. Does it answer your question?
Thank you. François Boissin from Exane BNP Paribas. Two questions, please. The first one is, when you look at your current markets, clearly Korea and Japan are constrained in terms of growth. Where are you most optimistic about future growth prospects in the coming years? And are there any markets where you want to be and where you're not currently? So basically any M&A opportunity there. And the second question is, you target 96% current year combined ratio in the coming years. What should we think about in terms of reserve releases going forward?
Sorry, the very last part of the question, we target 97 current year combined ratio. And what is the, sorry?
How should we think about future reserve releases?
Okay, sorry. Well, growth, I think, try to manage our profitability/growth dilemma and optimization at group level. Group being AGD level, AXA Global Direct level. So we are able to push in this country when we believe that incremental profitability is good and to stop in this country where it's not. So it's difficult to tell you where growth will be derived in 2015. It will depend very much on the growth/profitability perspective of each market. What is sure is that we have a quite negative perspective on the overall growth, not of our businesses, but of the market where we operate. I mean, the slide was, I think, clear on this. We think that the weighted average growth of our footprint markets will be nearly zero, but still we plan to grow between 7 and 12%. Where will it come from? I mean, clearly France will be a growing market. Italy is a market which I've not mentioned, but where we started a 100% digital business a couple of years ago, which will become profitable next year, and which is still growing very fast. Japan will most likely accelerate. There is huge opportunity for additional growth in this big Japanese market, which is still quite traditional. Poland is a market where we've been growing also quite fast. We have a number 2 position. I didn't mention it. It's still quite small within the global footprint, but it's still a promising market, even if this year as a whole the market is unfortunately contracting, but we are still growing quite fast. So I cannot really answer the question. Of course, I have some figures, but the likeliness of where specifically the marginal growth will come is likely to be different from what I would tell you today. Because what we really manage is how do we create the most value, and then we allocate it to the various countries where we are. But globally speaking, the countries I mentioned should be a big part of the growth going forward. China is excluded of this figure. China, for the direct part, is 20%. 20% of $500 million, more or less, is 100 million. So it's roughly 5% of our total footprint. And clearly, this piece of direct will grow extremely fast. So all of my comments is obviously excluding China, which should be an absolute major growth driver for the group and for direct clearly itself as well. Now, are there some other markets we are looking at? Yes, not so much in M&A, because unfortunately there are not that many direct or wealthy, healthy direct players in the world. And UK is not necessarily a market where we want to be overexposed. But we are looking at, we are constantly looking at new markets, but more through greenfield angle. So I will not name any names at this stage, but clearly, as we did launch Poland in 2006, and we did launch Italy in 2009, it might be the case that in the coming years, AXA may decide, we may decide collectively to launch a new business in a new market. And we have clearly a track record, I believe, in terms of launching and taking to break even more or less 5 years a new direct business. Yeah, reserve, I don't know if we disclose our reserving policy, but we typically in our business release 1 point. So our all-year combined ratio is typically 1 point below our current year combined ratio, sorry. Yeah.
Hi, Maxime Dupuis, Odo Securities. How explain, on slide C5, how explain such a gap between the growth of AXA Direct and the market growth? I mean, according to you, what does AXA have that direct competitors do not have? Is it pricing sophistication, customer acquisition costs too high? What is your feeling on that? That's my first question. And maybe about Tianping in terms of governance. Tianping will be managed under AXA Direct scope or under AXA PNC scope? Or there will be a split between motor or non-motor?
Yeah, let me maybe answer to the first question, and maybe I will ask, well, I'm pleased to answer the second question as well. Okay. On the first one, I believe that it's none of each of the pillars which makes the difference. It's the right combination of the three. If you have one but the two other wrong, you are dead. If you have two, you are, let's say, average. And if you have the three, you can have excellent return. And we believe as a team that we are getting to a stage, hopefully, where we can clearly overperform, as we've been doing in the past already, but overperform our market. It's not pricing alone, it's not acquisition cost alone, it's not cost alone. I think it's a combination of all. Again, just to give you a perspective, some of you are from the UK. Top players in direct can derive even much better profitability than the one we plan to deliver in 2015. So this figure may look aggressive. They are aggressive, but they are achievable, I believe, if we implement well. So it's really about execution. For the second question, yes, sorry. Well, it's a 50-50 joint venture, so where we have a number of seats shared with the other Chinese shareholder, and we have clearly a governance where some direct executives sit on the board, and Gaël, as well as François-Valéry Lecomte, our group CFO for Asia, is also sitting on the board. So it's clearly a joint governance. Clearly, for the matters more related to direct topics, my CEO for Asia, Xavier Véry, is sitting on this board and is taking a more leading role in the interaction with our colleagues. And for the other topics, more naturally, Gaël and François-Valéry are involved, but they really work as a team, the three of them, and so far so good.
Thank you.
Hi, good afternoon. Thomas Jacquet from Exane BNP Paribas. Can you remind us about your brand strategy and the way you manage the risk of cannibalization in certain markets? And an extension of the question is also your attitude towards aggregators, and maybe another extension is a potential threat from players like Google that could disrupt your business model. Thank you.
Yeah. So as you know, probably in most of the markets where we operate, we do not use the AXA brand. The three exceptions are Poland, Japan, and Korea, because we don't have large traditional AXA branded networks, proprietary networks. So in a country like France, we use Direct Assurance. In a country like Spain, we use Direct Seguros, and so on and so forth. We are happy with this. In terms of, and we do not plan to change this in the near future. As far as aggregator strategy is concerned, we clearly participate to the aggregator models. On a strategic standpoint, in most markets where aggregator exist, up to a point when, of course, we find acceptable commercial agreements with them. But this is the case in most markets. So yes, we play with aggregators. And in our business, aggregator is quite a good news, actually. It's an accelerator, and it's clearly a kind of marketplace where your competitive advantage can derive superior return because you adverse select your competitors each millisecond. So we like aggregators when we are at the right level to play against competition. And on the last question on Google, I think it's more a question for aggregators, but Google was planning to enter the aggregator market. They bought Beat the Quote in the UK 2 years ago. They started in France and I think in Germany. But they said, I think officially, that they were putting it on hold so far. And you should probably ask Google directly what is their strategy going forward for this marketplace. Thank you so much. I will be again here for the final round of questions if there are any additional questions or during the break. Thank you very much again.
So good afternoon, everybody. I have the chance to close this afternoon presentations, and I hope that you are still alive and very much interested by our business development in Asia. I've been working in AXA for 15 years after a first banking experience. And out of these 15 years, I have spent, and was very lucky to spend, 8 years in Asia, 5 of which in Japan, in our life operations, and 3 years in my current responsibility as a head of P&C operations in Asia. If there's one thing that I'm convinced about Asia is that it's not one, it's extremely diverse in terms of situations and countries, and I will try to highlight a few differences to you today. Today, I'm going to share with you our P&C development in Asia, where we are, what we have done, why we believe into Asia, and what is our ambition going forward. So let me start with Asia, a land of opportunities. In our P&C business, there are 3 key drivers: demographics, economic development, and insurance penetration. So let's take Asia, demographics. By 2015, Asia will represent 60% of the world population. So just to quote a few figures, Asia, in the countries we are in, we have Singapore, Hong Kong, less than 10 million people. Malaysia is 25 million people. You have France in mind, let's say at 70 million people. And now we move to Indonesia, 240 million people. India or China at 1.3 billion people. So with that demographic power in Asia, we have a strong opportunity in terms of business development. And in addition to a strong demographics, what we foresee is that by 2030, more than 60% of the middle class spending will come from Asia. Economic development. Yes, Asia has slowed down over the past months. Now, I hope you will agree with me that from European or US standards, the growth that we see in Asia is still very much better than what we have in Europe or the US. So it's still very much a business opportunity. Insurance penetration, Asia today is at less than 2% of P&C premiums out of GDP, actually 1.6. If you compare to US or Europe at roughly 4%, this is a great business opportunity going forward. So we have started our journey in Asia a few decades ago. From a group perspective, and you could see that in Jean-Laurent's slide, we are still very small from a group P&C perspective. From an Asia perspective, since the end of 2012, we are now the first international P&C player in Asia. Asia P&C is an integral part of our AXA Asia strategy. We benefit from a strong regional platform which is servicing both life and P&C operations. We are one of the few composite players in Asia, and it allows us to leverage our distribution agreements and also, and more importantly, to serve our customer base, a much wider one, through their life cycle protection needs. We have built over time a very strong franchise. It is now ranked number 1 as a multinational company in Asia. We have operations in Japan and Korea, and Stefan mentioned them. They are only direct operations. My scope is on what we call traditional P&C business, which will cover 7 countries, and which will fully benefit from Tianping acquisition from next year onwards. In most of our markets, we are growing faster than the market while increasing our profitability. So let's look at our positioning. Back in 2010, AXA Asia was a little more than 500 million euro GWP, with Singapore and Malaysia representing a fair share of our operations. In 2012, we have now doubled our size with 1.1 billion euro of revenues across our Asian countries. Singapore and Malaysia remain very solid operations, and we have, in addition, India, which from a company which did not exist 5 years ago is now the same size roughly as Malaysia or even Singapore. And we have Hong Kong, which is benefiting from the acquisition we made 2 years ago from the HSBC insurance operation. So these 4 countries are strong pillars of our development. We are today number 1 in Hong Kong, number 2 in Singapore, number 7 in Malaysia, and number 10 in India if you focus on the private companies. By 2015, what you see is the dotted bubbles representing where we see our entities developing, and you can see from the chart the massive opportunity that we see coming from China. So we have delivered strong growth and accelerated earnings over the past years, and we continue to have strong ambition for the future. In line with Ambition AXA, Asia P&C will more than double its footprint between 2010 and 2015, and will significantly more than triple its earnings between 2009 and 2015. This acceleration is coming from 2 key factors. The first one is with continuous strong growth, we have all entities which are going to reach critical size and scale over the next 2 or 3 years. The second element is our revenues acceleration is translating relatively rapidly into earnings on the P&C side. The combination of these 2 explains the strong acceleration of the earnings momentum. So I've just shared with you our geographic diversification. I will now focus on our business diversification. Our activities in Asia are well balanced between motor, commercial lines, health, and lifestyle. What we call lifestyle is travel, home, personal accident. Our growth over the next 3 years will come roughly 1/3 from motor, 1/3 from commercial lines, and 1/3 from health. So let's focus on motor. Motor in Asia represents roughly 50% of the P&C market, roughly 40% personal motor, 10% commercial motor. If you take the car market, more than one car out of 2 will be sold in Asia by 2030. We expect by 2030 to have 820 million cars in Asia, which is roughly the sum of Europe and US combined. Which means, together with the car market development, there is a strong opportunity of motor insurance development. So we expect our operations to grow at more than 15% annual compound growth rate between 2010 and 2015. We have already solid positions in Hong Kong, we are number 1, and in Singapore, where we are number 3. We have 2 types of countries, basically. We have Hong Kong, Singapore, and even Malaysia becoming more and more mature countries with aggressive and very competitive pricing environment, where the key to success for us will be to increase our technical pricing and segmentation, and to revamp our product offer to differentiate further towards our customers. And we have another set of countries, which we call developing countries or developing entities, where the car market is not yet mature. Out of 1,000 people in those countries, less than 100 have a car. Keep in mind, in the US, 800 people out of 1,000 people have a car. So that gives you a sense of the magnitude of the car development opportunities in those countries. So in those countries, what is at stake is to make sure that we have a strong distribution reach to get after our customers, propose them a car insurance cover. What is at stake as well is to be agile in terms of technical pricing to make sure that we develop our business in a profitable manner. So we have three key focus when we develop our motor activities and three key drivers of success. The first one is technical expertise. That is absolutely essential if we want to develop our business in a profitable manner, that we increase our pricing and segmentation capabilities. We have started to do that, and over the past 18 months, our loss ratio has decreased by 2.7 points in Asia overall, by 9 points in India. We are also focusing very much on claims management, and this is both difficult, because in markets which are growing very fast, it's always difficult to have a good control over your claims management, and notably on fraud aspects, but it's also a key opportunity going forward to improve our profitability. So I just listed a few actions we are taking on claims side. I will highlight claims fraud. We are taking strong actions to improve our fraud detection, and today we are making good progress with fraud savings out of our total amount of claims that we are paying is now at 0.5%, or was last year at 0.5%, is now at 1%, and we target to reach 2.5% by 2016. And just to give you a perspective, our mature entities today in mature countries are at a ratio of 3%. We are also taking strong actions in terms of procurement to build agreements with our workshops and reduce the cost of repair that we have through our claims. The third action we are taking, and that's probably the most important to sustain our business over the long term, is customer focus and customer differentiation. And you will see a few examples of that going forward. Commercial lines. So we believe commercial lines will continue to be an opportunity in Asia on the back of strong economic development. With economic development comes urbanization. With urbanization comes construction, exports, marine business, property development. So many opportunities related to commercial lines. In the past, over the past 10 years, AXA Asia was not focused on commercial lines development. Why so? We were relatively small, and with a relatively small balance sheet, commercial lines can be a risky game. With the size that we have today and a much stronger balance sheet, we are ready to accelerate in commercial lines. We have started to do so, both in commercial lines and, more importantly, in a diversified manner. We had started to accelerate on commercial motor, and that's what you can see on the slide. We are now accelerating in all dimensions of commercial lines. We have today a well-balanced portfolio between short-tail risk and long-tail risk, between property, construction, and liability or marine business. We are very much present in the what we call the mid segment. We are going to accelerate in both the very small SME market, to please Amanda, but not only to please her. We believe there are many opportunities. And we are going to accelerate in the large segment. On the large segment, we are going to do that together with AXA Corporate Solutions. This is a segment which is of sizable risk, where we need to have a strong technical expertise to develop our business in a profitable manner, and this is where we can leverage strongly AXA Corporate Solutions to do it the right way. Key element of success in our development will be our capacity to strengthen our teams. We have today across Asia roughly 100 underwriters across our 7 countries. We have started to strengthen their expertise towards very specific technical expertise in line with our standards of underwriting. There is more room to go, and we continue to do that, both at regional level, but also leveraging on group expertise. Our last significant driver of growth is health. Health is a growing opportunity in Asia. for two main reasons. The first one is there is a lack of welfare support, which is therefore creating a massive protection gap. The second reason is the Asian customers are much more aware of their health needs and therefore much more willing to buy protection for their own health. So these are key business opportunities which we are tackling both through our life operations and our P&C operations. On the P&C side, we expect health operations to grow at more than 35% annual growth rate between 2010 and 2015. And we have already built solid positions. We are number one on the P&C market. We are number one in Hong Kong, number 2 in Singapore, and number 5 in Malaysia. So these drivers will allow us to continue to grow fast, and the last dimension to facilitate and support our growth will be our multi-channel distribution. We have a strong agency network in Asia. Keep in mind on the P&C side, what we call agents is non-proprietary sales force, non-exclusive sales force. So these are agents that somehow we need to convince to do business with us. Agents today are representing more than 50% of our business development, with strong acceleration and diversification, notably towards health and commercial lines. We have increased our footprint towards agents by 60% over the past 2 years. Brokers is another significant channel for us in terms of development, and we expect revenues from brokers to double between 2011 and 2015. Mostly coming from health and commercial lines. And just to put things in perspective, 1/3 of our commercial lines business is coming through brokers, and 40% of our health business in P&C is coming from brokers. Then bancassurance. Bancassurance back in 2010 was a very small distribution channel for the Asia P&C. It was representing less than 5% of our GWP. In 2012, it is now representing more than 20% of our revenues generation. It will continue to be at that level over the next years or even increasing further. What you see in 2015 is the impact of Tianping, which is included into 2015 numbers, with a strong direct component, which is therefore diluting the bancassurance. If you exclude Tianping from 2015 numbers, bancassurance would be at more than 20%. Let me take 2 examples of bancassurance agreements that we have done over the past 2 years. The first one is HSBC. So we have bought 2 years ago HSBC insurance operations in Mexico, but also in Singapore, Hong Kong, and we have built exclusive agreement with HSBC in Mexico, Singapore, Hong Kong, but also India, Indonesia, and China. This builds access for us to 6 million customers of HSBC, with still a large opportunity to further develop, as we are today, quote, quote, only at 8% customer penetration. As of today, all the agreements are in place in the 5 countries, and we have started to develop and accelerate the business development. We are in line in terms of business plan. And if you look at notably HSBC, Hong Kong, and Singapore operations, through the integration, we have been able to retain more than 90% of the HSBC customers into the AXA operations. Second example is Mandiri. Mandiri is the largest bank in Indonesia. We have had for many years now a very successful operations on the life side, and we have launched with Mandiri a joint venture on the P&C side at the end of October 2011, with the objective to become a significant player on the P&C side in Indonesia, building on the large subsidiary that Mandiri has on the motor financing, it's MTF, and also on the loans that Mandiri is providing to customers for their house. We are strongly developing, therefore, from both motor and property businesses to start with, and we are going to accelerate also on the small commercial lines businesses on the Mandiri customer base. And what you can see in the chart is an impressive business development so far. So we have been quite successful so far. We have a strong ambition, and we believe that one of our key success factors going forward will be our competitive advantage. Let me elaborate on this. Asia has its own set of challenges between sometimes a very aggressive and not always rational competitive playing field, moving regulation, significant natural catastrophe, and talent war. What are the key assets that we have in AXA Group that we are using to face those challenges? First, we are a composite player, and we are one of the few players in Asia to be composite, which means we can propose to our customers full-fledged protection solutions across their life cycle. Second, we have a very strong regional platform, which, if we combine it with our global standards and technical expertise to develop business, allow us to build a very strong P&C platform in Asia. Thirdly, we leverage on the AXA Group technical expertise, notably to address the natural catastrophe, and I will come back to it. And lastly, I would like to highlight the insurance brand. For the 5th year in a row, AXA Group has been recognized as the first insurance brand worldwide. We are clearly not there yet in Asia, and we are punching below our weight. We are aware of this, and we are investing very significantly to catch up, and I'm very confident that over the next years, AXA will become one, if not the, first brand as a multinational player in Asia. And lastly, together with the brand and our promise, we are not shy to reinvent ourselves, and I will show you also an example of this. So let me focus on reinsurance and natural catastrophe. Yes, Asia is exposed to natural catastrophe, and if you remember 2011, 70% of the natural catastrophe worldwide were coming from Asia, 70%. Key to success to address those natural catastrophes is two things, very simple. Our reinsurance scheme and our underwriting capabilities. So where do we start from? First, we define our risk appetite in line with our group risk management standards. Second, we control our underwriting to make sure that the business we take on board and we underwrite is in line with our risk appetite. Thirdly, and you would say maybe it's obvious, but it's good to do, we are monitoring our risk accumulation. And we are notably using group tools to do that. And lastly, thanks to the AXA Group and the AXA Global P&C technical expertise, we are able to build a reinsurance scheme which is leveraging on both a scale and diversification across Asia and across the AXA Group. So all in all, just to give you one example, so we are covered for events which are one every 200 years. And if you take a Nat Cat event, significant one, the maximum net retention for AXA Asia would be 1.4 million euros. Now, what I want to share with you is how in Asia we are going to take and to enter the digital world. And I will take also the word from Amanda. This is not about putting our existing products on the net. It's a much bigger opportunity that we are talking about. It's about starting from the customers and taking the opportunity to better understand what are the customer needs and the customer's expectations in terms of protection and in terms of solutions. And it's about building a solution which is simple, transparent, and value for money for the customer. So we are building a platform across all our Asian countries, which will serve all our retail lines, motor, travel, home, PA, but also SME, which will be fully automated in terms of underwriting, both for our agents, our bancassurance partners, and potentially our customers. And we connect this platform directly with our back-end system, which will allow us to deliver efficiency across our operations, which is good for our earnings, but more importantly, it will allow us to be extremely agile in the digital world of today, where we will be able to go from what is today the reality in our markets, where we are able to issue new products in 2 to 3 months or to revise our pricing in 2 to 3 months, to 10 days in our new future platform. Let me give you an example live of what I'm talking about. So I will focus on an example of our digital platform on a specific set of products. I just want to remind you to start with that today, 45% of the world internet users are in Asia, and more than 30% of Asia is connected online today. What I want you to have in mind when I do the demo is we are looking for simplicity, transparency, and value for money. This is a demo about very small SME business, and we have been very much inspired by what Amanda is doing and has been doing in the UK, on the UK Wizard and the SME platform that you have built, Amanda, to build this platform. So let me start the demo. So I do the demo for my iPad. I'm sorry for the people who are online who do not see it. I will try to explain to you what I'm doing. Okay. So let's start. So this is SME platform adapted to the Singapore market. The objective is to cover very small SME business. We want to have a very simple underwriting process so that we make it simple for our customers to underwrite. We start with a self-declaration from the customer on, maybe you cannot see it, but on whether they have had claims or not, and whether they feel that their SME is reasonably protected. If you have a doubt whether you meet or not those constraints, you can already fill your details and get contacted by the customer center to then find a solution more appropriate. But let's assume that yes, I match those criteria. What we have done is we have done an extensive customer study and customer analysis in the Singapore market, but also across Asia. And we have identified that depending on the business of the SME, the basic coverage needs are not the same. So we have built specific categories of businesses, for which each category we have designed a very basic cover. So if I take personal care and daily needs, I would have an identified set of basic cover for a starting price which is identified from the start of the process. If I have a cafe or restaurant, I would have another basic set of covers, and I would be the same for office or a different set if it's a fitness center. So I'm sportive, let me start with a fitness center. So the cover would start from 268 Singapore dollar, and I'm interested by the basic cover provided, so I get started. So I'm sorry because I cannot make, doing the pinch on the iPad, I cannot make it bigger, so I'll try to explain to you. We start with must-have. In must-have, we have 2 basic covers which are compulsory from a regulatory standpoint. These covers are all risk-real. Today, by default, it's 100,000, but let's assume my fitness center is big and I want to cover it better, and therefore I increase the cover to 200,000. Work injury compensation, by default, is for 3 employees. You will see that I cover maximum 25 employees. Let's assume I have 10. Then we have a set of recommended options. So the recommended options is like Amazon. Amazon, you buy a book, and then just after, Amazon recommends you books that other customers who have the same profile as you have also bought. Recommended options are exactly that way. We have identified for those customers in fitness, they have the basic cover, but also they are usually taking also these recommended options. So theft of money, yes, I'm interested. Public liability, I think it's good to protect myself if anything happens within my fitness center. Daily cash, actually, I would like to increase the cover to, let's say, 700. Actually, it's a simple, very small SME business, so I'm not allowed to extend above 500. So I would go to the maximum at 500. And all my employees are based in Singapore. I don't expect them to travel, and so I will not take the worldwide personal accident. Let's assume I'm interested as well to protect my building against fire. I have a recollection of the basic cover that were presented initially, and I have the option for 55, and sorry, maybe I forgot to mention to you, at the bottom of the slide, of the screen, you have the price, which is updated every time I do a change. So let me take out the fire on building. The price is now 620. If I add it back, it's 670. So my question is, do I want to insure my building on fire for 50 additional Singapore dollar? And my answer is yes. So I have a clear view on what is the price associated with the offer I'm providing. And then for 55 more Singapore dollar, I can double the cover on the basic covers which are provided in this package. So now I'm at 725. And I need to enter my details. And I have a nice mention on Twitter about the AXA IRD. Should come soon. So what you need to keep in mind is, one, we start from the customers, and we design the offer starting from basic cover, starting from basic cover to more and more features that we add, so that we fit exactly with the customer needs. So I just entered dummy data, because what I want, I don't have a mortgage. I enter my mobile number. What I want to highlight here, phone number of the office, is this input of mobile number and emails are made compulsory on this platform. Why? Because we want to be agile and we want to be able to address our customers in a very reactive mode. So I have entered my direct connection numbers. I continue. I set the date to start my cover. I confirm the price is the same as the one I had seen earlier. But I want to check the policy terms and conditions to make sure that what I have understood in my cover is really what I will get. So I have the extensive policy wording in PDF format, and based on that, I agree to proceed with the payment. Once I proceed with the payment, I will receive by email the policy wording, and I'm insured. This platform that I've just shown you on the SME, we have the exact same mindset and platform which is being developed in motor, travel, home, and PA across all our Asian countries. And the good thing about this platform is we can brand it easily for our bank assurance partners. So going back to my presentation, in conclusion, what I would like to insist on or highlight is maybe 3 things. One, we believe Asia is a strong land of opportunities and represents a strong market potential. We believe that because there are three key drivers that we see in Asia which are supporting our P&C operations: economic development, insurance penetration, and demographics. We are today well positioned to meet our Ambition AXA targets. We are growing faster than the market in most of the markets we are in, and we are translating this growth into earnings. Our key drivers of success and why we believe we can be successful is one, we are well diversified, both from a geographic standpoint and from a business standpoint. So we are able to absorb the shocks which will arrive in Asia. We also benefit from being global, and there is a lot of expertise that we build on coming from the AXA Group and from the most mature P&C businesses that we have to build solutions and to develop our local expertise. And key to success will be our people, our capacity to motivate our people, to attract talents, to have them play a role into our ambition. And the good thing about where we are in is, given the size we have and the ambition we have, each of the AXA P&C employees in Asia has a role to play. So thank you for your attention. I will now ask Mike Bishop to join me on stage to take your questions.
Any question?
Obviously, a very clear presentation.
Yes.
Hi, thank you very much. Farouk Hani from Citi. I remember when you acquired Tianping, there was a bit of consternation because, for right or wrong reasons, because obviously it appeared that you were paying a multiple that was bigger than where P&C insurers trade in China. Now, I know you can't compare what you bought and what you're doing with it with those insurers, but there seems to be a sense in the market that it's a very difficult P&C market from a profitability standpoint, from a regulatory standpoint. Can you just run through in a bit more detail why it's different, what you're doing will be different, apart from obviously direct and motor? Thanks.
I think the first thing is with Tianping, we buy a profitable business. There are not so many profitable businesses today in China. Tianping is one of them. It's a company which was launched and created 7 years ago, has been profitable over the past 3 years. Strong growth momentum, good combined ratio, good reserving capabilities, extremely good management team. What we do is we intend to build with Tianping management team and through a 50-50 JV, a strong acceleration towards direct motor. We do not intend to compete with Ping An or PICC through a traditional agency sales force. We believe that where we can bring a difference is leveraging on exactly what Stefan has elaborated on AXA Global Direct. We have a strong direct expertise at the group level. We can bring it to Tianping and build together a very successful direct motor business. In addition to that, we can build on the other P&C strengths that we have to further accelerate on retail non-motor. SME is an example, health is another one, travel, home, and also on commercial lines. So where we start from is we have a strong platform that we are acquiring at 50%. We combine our efforts between a strong Chinese team, which has been very successful over the past years, strong direct expertise, and we combine it to build a successful player going forward. For this, we pay 500 million euro to be able to enter the Chinese market fully. And remember that until last year, no foreign company was allowed to play in the motor TPL market in China. So we will be one of the first foreign insurers who is able to enter the motor market in China. And in China, motor is more than 50% of the P&C market. And China is a big part of the 820 million vehicles I mentioned in Asia. So we are able now to enter fully the Chinese market and to leverage on Tianping presence to accelerate also on commercial lines. So that's where we believe the value proposition is. Come back in a few years' time to make sure that we are delivering. But honestly, so far, the relationship is going extremely well. We have a very strong entrepreneur, pragmatic mindset in front of us on the Tianping side, and we are making very good progress on the integration front.
I think just to add there, we were quite constrained before within Shanghai. This opens up the whole of China. It's unique for us. And you just look at the numbers over the next 10, 20 years, I think you can see why we are bullish on China.
Thank you very much for the presentation. Very good. Rafael Villarreal from BNP Paribas Fixed Income. I was wondering, how do you feel confident about your pricing if these are new markets, these are undeveloped markets you're entering, and I imagine pricing has to be based partly on what you expect the claims to be. I imagine the claims development in these countries could differ substantially from those of the markets where AXA has traditionally operated. Could you tell us a little bit about that, please?
Yes, I would go even further. Across Asia, the situations are extremely different from one country to another. So we have countries which are still tariffed, for instance, Malaysia. Malaysia in motor, in property, is a tariff market. So our ability to impact the pricing is extremely limited. So what we do is we focus on segmentation and risk selection. Now, there are markets where there is no tariff, India, as an example, but extremely aggressive and competitive in terms of pricing. Where we make a difference is technical pricing, segmentation. We are not shy to increase prices by 30% in Delhi, for instance, to make sure that we become profitable. Yes, there is still an area of uncertainty about how the claims are going to develop, and what we do is very regularly we review our claims monitoring and we make sure that we are well aware on how the claims are developing. And for that we are basically using the methodology at AXA Group level, taking the same discipline but extremely regularly to check that what we are doing fits what we are assuming fits what we experience on a day-to-day basis. And so far, loss ratio is improving in all entities, while growth is significantly accelerating. So it's a good sign. And in many of our markets in Asia today, we are now in a position where we see positive current year reserving development, which is also a good sign that while we grow significantly, our business is still very much developing in a healthy manner.
Afternoon, it's Andrew Queen, Autonomous. Could I just ask, in terms of your footprint in Asia on the P&C side, whether what is most important? Is it building out organically in the markets you're already in? Is it reinforcing by acquisition in the markets you're in? Or are there other markets where you wish to enter and would need to acquire?
I would say we have made significant acquisitions over the past 2 years, as well as significant distribution agreements. And I think the combination of the two is extremely important to us. Doing only acquisition would not be necessarily the solution for our development. If you look at today's positioning, we are strong in Singapore and Hong Kong. We are strong in Malaysia. We have a very successful business in India. We have a very good opportunity with Mandiri in Indonesia to accelerate our business development. And we have Tianping in China along the road. So in those 6 countries, we are well positioned, and my issue is more organic now, making sure that we are successful in those countries. There are a few countries where we are not yet, or where we are small, and I think it will depend on opportunities. But if you keep the big picture in mind, where we will be successful in the coming years if we are successful in China, India, Indonesia, the big markets after all.
I mean, I think just to extend that, we're open-minded, we're aggressive. I think, you know, we have big ambitions for Asia, and if we see an opportunity for profitable long-term growth, we will obviously take it.
Hi, Jaime Ramos, Standard Life. Two small questions. On the HSBC distribution agreement, you mentioned that 8 and 5% penetration is very low. What is a normal penetration? And then just maybe I missed it in the example, but where is the geolocalization on that underwriting that you were doing on the? I didn't see any area that you put the address and the postcode, and just to understand it. Yeah.
Okay. So on the first one, HSBC, I'm not sure there is a normal rate. What I would say is when we look at our bancassurance operations across the world, when you start to reach 15, 20%, you start to have a very, very successful bancassurance partnership. 8% in Hong Kong is a mix of something like 12% in the retail banking and 5% in the commercial banking. So there is room to grow further. 5% in Singapore is probably still small or still an opportunity to increase further. On the geolocalization, we are talking here about very simple underwriting, so small businesses. So the risk is less on the localization. We would have clearly the geolocalization on the bigger risk, medium enterprise, so mid-segment, and definitely the more you go for the large size of risk, large and corporate, the more the Aegis tool or the geolocalization will be important.
Hi, I'm Maxime Dupuis, Odo Securities. First question, when you acquired Tianping, I think you had the hope to be profitable in 2015, which is no more the case because of increased expenses to accelerate growth. When do you think to be profitable in China? I'm on slide D9. And maybe second question, in terms of distribution and the stability of sales force, is there a strong turnover in these Asian countries, or it's a false idea? Thank you.
Okay. I'm not sure we have said that we would be profitable by 2015, but the integration with Tianping is just starting at the start of next year, which will be 2014. We will be massively investing into the platform and marketing investment, so it will take a few years. 3-5 years before we get to profitability aspect. I think what you need to track is whether the business momentum is increasing in line with what we have in mind, and whether the loss ratio is also improving in line with what we have in mind. And so far, we still have a very aggressive plan on China with Tianping. Your second question?
About sales turnover.
Yeah. So remember, our agents are non-proprietary, so it's more to what extent, not so much they stay with us, but they are active with us. And so far, when we look at the number of active agents that we have on the P&C side in Asia, it's increasing strongly over the past 2 years. So it's a sign that agents are continuing to work with us. The type of platform that we are building here is, for me, an opportunity to somehow build more stickiness from the agents towards AXA.
Okay, thank you.
Good. So maybe we stop the Q&A on Asia, and I think Jean-Laurent and Stéphane, you join me on stage to take the more global Q&A.
So we are getting close to the end of the Investor Day. We are available for you, as well as our colleagues in the room, for answering all the other questions you might have on our P&C operations.
Thank you, Farouk Hani from Citi. Just going back to a question I think that Francois asked earlier about reserve releases. I mean, you gave quite a short answer. Your reserve releases appear to be different or lower, obviously compared to your history and compared to other companies that we think have a very similar business mix. So there are 2 or 3 explanations for that. Either your current year reserving is closer to best estimate than peers, or you're rebuilding prior year budgets, or there are big differences in business mix or approach that we're not taking into account. So which is it? And also, do you see any opportunity for that 1% to grow in a bull case? Thanks.
So, first of all, as an answer, we do not want to be that much dependent on our balance sheet in order to build the profitability of our business. So when you have a business which is very much dependent on prior reserve release, it basically means that you are not able to deliver profitability through the current year and the business you are developing at the moment. At AXA, we said that in terms of guidance, we will have globally around 1 point of reserve release per year as a mid to long-term view. And we showed in the slide this morning that we have reduced this prior reserve impact over the last 3 years. So this is what you have now on the chart. We've been between 1 and 2 the last years, coming from a higher level of reserve release. We are up to 5 points in the year 2008. I think this is very much dependent at the same time of the cycle of the market. And that's clear, that's right, that if you compare us to competitors, to large competitors, we are today less dependent from prior reserve release. At the same time, we have not changed our reserving policy, which means that we are sticking to the same level of, let's say, security of safety in our reserving policy. We have not dramatically changed our business mix. We have around 190% of our earned premium in reserves, which means that we are at a healthy level depending on the various markets we are in. So this being said, no reason for changing the guidance in the future. We expect to have 1 point or a little bit more gap between our current year combined ratio and all year combined ratio, and we stick to the discipline we have shown the last years in order to go on improving our current year combined ratio and to develop a profitable business for today and for the future.
Nick Holmes at Soc Gen. I wanted to ask about the 96% combined ratio target in 2015. And in particular, how concerned are you about the very low claims frequency that is a feature of a lot of European P&C at the moment, especially motor? Do you think, I mean, your loss ratio is benefiting from this. I wonder perhaps if you might be able to quantify what that effect is and to tell us where you expect this to go, if you would expect your loss ratio to get worse and be compensated by improvement in, say, expense ratio in order to reach your 96% target. Thank you.
Yes, I think it's a great question, and it's mixing several aspects. First of all, it's true that in some markets, we are currently enjoying a low frequency in terms of motor claims, notably in markets such as Belgium or Italy. It's not the case in all markets, and it's only for the motor business. So really, we have improved the profitability on the motor side, but we still have quite an interesting room for improvement, or quite an important way to go in terms of profitability improvement on the household side. On the other end, we have, let's say, some competing factors that are at work today. Lower frequency of motor claims, higher frequency of average natural events that are affecting the property lines, be it individual property, household, or commercial property. So in this second space, we intend to increase further pricing and to monitor an improvement of our overall combined ratio. So if you ask me what are the drivers for improving further your combined ratio, I would tell you that in property, given what we had in the recent past in terms of, let's say, high frequency of natural events in places such as Germany, France, with floods, hails, freeze, all this, I think that here we have a real interesting space for improving further. Then it's part of our business to manage the cycle in terms of the motor business evolution. We have, let's say, a good quite good frequency at the moment, depending on the market, but higher severity in some markets, and we need to have some, let's say, further regulatory improvement in order to better monitor some of our claims. We are notably working on this on Spain in order to have some better baremo for the bodily injury claims. So I think that it's very much a mixed picture, and we cannot only limit the observation to what is today the frequency in terms of the motor claims. Our combined ratio is composed of much, let's say, more diverse components. And even in the commercial line space, it is already, and it will be in the future, as already explained, a more and more important part of our business. So also we will focus on this in order to monitor the combined ratio positive evolution in the future.
Yes, Atanasio Pantarottas from Kepler Cheuvreux. I have two questions. First of all, regarding the balance between investment yield and combined ratio target. You mentioned at the beginning that your current yield on assets gross is around 4%. However, I think that provided no big jump in interest rates, this should go down in the next years. And I wonder if you can provide some color on this, and if this would imply that you should target a additional improvement in the combined ratio even below 96% to offset the declining yield on assets. Second question, if you can provide some more color on the definition on price increase, just to understand if you are in line with your competitors, so how you calculate the price increase in your P&C business, which provide normally in the presentation. Thank you.
So I will try to answer the first one, and will be complemented by my colleagues on the second one. On the first one, it's true that as all the players, we are facing a decreasing interest rate environment. But I already said that we are quite successful at mitigating and smoothing the impact through the tight asset management we have. We have a very short duration gap. We are also investing somehow in alternative asset classes in order to strengthen a little bit our yield, our drill, and to try to maintain it at a decent level. What is clear is that the question you raise in terms of compensating one line with another comes to the question of earnings. So what we try to do is to develop our earnings at the right pace, as we have announced in Ambition AXA. And I think that in order to have a good development on earnings, the idea is maybe less to improve further the combined ratio. Still, it's possible on a market-by-market analysis, but the idea is also to strengthen the growth in the areas where we are particularly profitable in order to improve overall the mix and to have a better contribution to your earnings. This is what we intend to do. This is what you could have noticed from Stéphane's presentation on the specific direct market, that in the past was a market for investment and not for getting the return, and now we are getting the return. return. This is also what we aim at doing for the commercial lines business with what Amanda and Philippe Rocard explain you on some specific markets and overall in the group. So managing the investment yield, it's part of the overall management of the earnings through managing and monitoring the business mix towards the places where we know we can make a difference in terms of technical edge and in terms of mastery of our overall margins and profitability. Maybe for the price increases, I will let Stéphane and Gaël give you their personal insights. Stéphane, from other markets.
Yes, I think I agree with you. We are getting out of a quite favorable part of the cycle. Now, I mean, we are not expecting radical changes. So, I mean, in quite some markets, we see some positive trends in terms of price increase. Of course, there are big differences in between markets, and even if frequency have been declining, as Jean-Laurent said, severity has not been declining as much, has even been increasing in most of the markets. So, all in all, we do not expect, I mean, radical changes, at least in the motor business, yes.
No, as far as Asia is concerned, we are clearly impacted by the inflation that we have in many of the Asian countries. So we take that into account when we look at the price increase, and we combine that with, similar to all our other P&C businesses, with frequency development, severity development. We end up with a price increase for our P&C operations in Asia, which is generally more or less in line with inflation, or slightly less if we have some aggressive positioning on some specific risk.
And maybe interesting or important to precise that when we talk about price increases, what we try to capture is the price effect that we have in our portfolio coming from our pricing policy. So it is the net effect of our pricing policy. So the last figures we have disclosed was plus 3.1% for the first half of this year. So this is definitely the total, the overall price effect we have from our pricing policy inside our P&C portfolio. So this is what we do. And then this is a result of many actions to be taken line by line, market by market, network by network, with all the monitoring of that thing. This is really important in times where the cycle could change or evolve. That's why I was very much insisting this morning on pricing discipline. And this is also what we try to do on the commercial lines space, monitoring very precisely the renewal campaign execution, because it is there that we can win some additional points of profitability. So many hands.
Andrew Green is autonomous again. Could you just say what you budget for large claims and for exceptional weather every year? And secondly, declining motor frequency is a feature of a lot of markets in Western Europe and the United States. To what degree do you see this as cyclical to do with the economic scenario, or structural to do with aging populations, getting better at driving, and possibly crash avoidance technology and some of this stuff?
To your first question, our intention is not to disclose the budget we have for large events or large claims. Of course, we are paying a specific attention to this, and the comprehensive setup we have, the overall organization we have, allows us to have quite a precise vision market by market, learning from experience and building our plan for the next years with, let's say, a clusterization of our claims between attritional, large, and all this. But say in terms of figures, we do not intend to give any guidance on this. But this is part of our process. And when we disclose the result, we explain what is due to large claims or what is due to natural events. In terms of the second part of our question, what is the root cause of the decrease of the claims frequency, notably in Western Europe? I think there are several factors. Of course, the economic crisis is one of the important factors, notably in Southern Europe, and notably in countries such as Spain, for instance. But they are not the only one. You mentioned the aging of the population. You could add that there are some public policies in order to have better, let's say, safe behaviors on the road. It's notably the case in France. And also you have the fact that technology is making progresses every year, that the new cars are far safer than they were in the past. That also through the infrastructure, the way the speed is checked and controlled, there are some strong incentive in order to reduce speed and reduce the claim frequency. So my strong hope is that an important part of the decrease of frequency is due to good reason, but it's true that what is linked with the economic crisis will probably, hopefully, if we have some recovery, vanish over time, and that we could see some upward trends coming along the increase of the activity. So I think this is the feeling we have on our markets. Stéphane, you want to add something?
Yeah, I mean, I fully agree with what Jean-Laurent said. Another, I mean, criteria is clearly the price of the oil, and there are some correlation in the number of kilometers driven, and clearly this is something that we follow. Now, this evolution of frequency, I fully agree with Jean-Laurent. There is a kind of structural declining effect. There might be some uplift at some point of time, but I think the trend is really going towards this direction. Now, what we have to keep in mind and what we follow extremely closely is the severity. And if we have cars which are more secure, they also cost more in general to repair. So the attritional or damage part cost is structurally increasing in all markets, even if we have actions to control our average unit repair cost. And same on bodily injury. In all markets, the tendency is to go towards a higher severity. So all in all, the pure premium impact is not necessarily going down. So this is why we do not expect, clearly completely different trends in the coming years compared to what we show in the slide. Yeah.
And if I may add something linking with the previous question, the decline in investment yield is a reality which is faced by all competitors, which means that they can and we can rely less on investment income, and we have to rely more on technical results, technical margin, in order to build up a profitable business. So this will remain true for all competitors and all markets.
Raphaël Caruso, Raymond James. 3 quick questions regarding your direct strategy. What is the link and the main synergies between the lab you just opened in San Francisco and AXA Direct branch? Second question, are you targeting specific clients, for instance, young people? If yes, in what extent do you increase your presence to social network or new technologies compared to your peers? And finally, do you see significant differences worldwide in terms of behavior? I mean, what is the most dynamic direct market according to you? And why don't you want to enter the US direct market? Thanks.
Well, that's 3 questions. So the first one, when you said AXA Direct branch, you mean AXA Global Direct, AXA Direct Business. So the first question on the data innovation lab, there are clearly some correlation. The AXA Group, Véronique and Jean-Laurent and all of us have decided to launch 2 initiatives. One is this lab in San Francisco, and another one is what we call the Data Innovation Lab, which is a lab that will be headed by Véronique, but that I will sponsor at group level. And clearly the idea is to invest even more heavily in predictive modeling and data understanding globally, not only for motor business, but clearly for several of our businesses. So there are some correlation. AXA Global Direct is sometimes a bit ahead on some dimension, especially in the motor business, but this lab will cover many other areas such as health, protection, commercial lines, and Jean-Laurent mentioned an example earlier on. So there are some correlation, and these labs will be very close to the businesses. So they are not supposed to do what the MIT or École Polytechnique are doing. They will be close also to the academic world, but they are supposed to really deliver business value to our business entities. So that was the first question. The second question was, yes, we are effectively, I mean, we have clearly a higher share of young people. And actually, we look more and more after them because the more we are improving our underwriting and pricing capabilities, the more we are able to underwrite them at a good margin. Because as you will know, there is on one side a very good mix in terms of marketing behavior between young and internet, let's say, or digital device, but at the same time, underwriting young drivers at a profit is not a given. But the more we go, the more we are able to do it, and we are clearly pushing in this direction. Now, the second part of the question was, are we active on social medias? Yes, we are learning. Yes, we are measuring. Yes, we are testing these tools or media as a way to optimize our reach. But it represents still today a quite small proportion of our total spending, globally speaking. And sorry, the last question was, do we expect one country to be
more dynamic in terms of direct markets?
This is a bit the question that I think was asked before. The answer is yes, China. I mean, China, as we saw, is growing intrinsically as a motor business, and the direct business is already 20%, is expected to go 30%. So this is clearly one very promising market, as Gaël and Mike said before. So we are clearly mobilizing our best people to make sure that we are successful in this market. And US, I mean, it's more a question for, I think, Henri, Denis, and Jean-Laurent, but I think, no, we are not operating in the US in commercial line, and I don't think we have plans to operate in retail lines.
Now, we have, as already mentioned, we have no appetite for P&C, and notably the casualty business in the US. It's a market which is dominated by specific rules, as you all know, with very strong purely local players. Also, a lot of issues coming from the lawyers and the way to handle the business in that space, in that P&C space in this geography. So, for us, we have no intention to move there or to change our policy.
Thank you. So, François Boissin from AXA BNP Paribas. Two questions, please. The first one is on bank assurance. You're making the case that you're growing at 33% in 2012, I think it was, or yeah. So basically on that, what is the like-for-like figure? I mean, does this figure include new partnerships? And basically, what in your view makes this business so attractive from a combined ratio perspective? 90% looks very nice. So is there any particular reason for that? And is there further scope to develop such partnerships going forward? And the second question was with regards to Tianping, sorry. I think the current market share is around 0.8%. What do you think a market share is realistic for you, I don't know, 5-10 years from now?
Okay, so I will take the first one on bank assurance, and we'll hand over to my partners for the second one. So first of all, 33% we showed in 33% growth in terms of our bank assurance business. We indicated what was the scope. I think we have probably a change of scope effect in Asia due to HSBC in this area. But we have market by market a very good dynamic, and the optimism or the confidence we have in this business model comes exactly from what Gaël explained. The fact that we have a very important room for improvement between the penetration rate of the P&C business in the customer base of our banking partners today, and what it could be in the best cases we know all over the world. We have notably some, let's say, interesting in Europe and very meaningful experiences with BNP Paribas in France and with Monte dei Paschi in Italy. Also, we know how powerful is the model if you look at local French competitors such as Crédit Agricole, for instance. So we are confident that with an efficient setup, there is an important potential of internal growth in some markets. For instance, in Italy, the Italian market is very much underdeveloped from a bancassurance standpoint, which is not the case in France or Spain, for instance. So that's why investing in this part, in this geography, we have strong hopes that this acceleration will be keeping on. In terms of the root cause is the true reason for having a better combined ratio in this area, I think there are three reasons, basically. First of all, the relationship between the bank and the customer is quite a strong one. It's not usual for a customer to change bank and to change all his operations. So, I mean, we are building on a relationship which is good, and when we are developing bundled bundled products or direct marketing operation, they have a very good success rate. Why is it technically better? Notably because the level of data and information we have on the customer side when partnering with the banks are much higher than what we have in what I could call the open market. And for instance, we are doing interesting studies in terms of correlating the scoring the banks are used to taking into account for developing their loans into the motor pricing, for instance. And this is something that have proven being quite powerful. Also, this scoring methodology applies to SMEs, for instance, for financing their activities. And this also could translate into a better pricing and underwriting methodology for the SME business in bancassurance. So definitely, this is an area where we have a strong potential for growing due to the level of current equipment of the banks we are partnering with. And second, we have an amount of data and a way of being very accurate in measuring the risk and doing the pricing that will allow us and already allows us to have very good combined ratio. So this is the precise reason. Second question was about
market share for Tianping.
Market share for Tianping, yes. Not recalling.
So it's always an assumption for the future, but the numbers we have in mind would be roughly to have 2% of the motor market share over the next, let's say, 3 to 5 years, and probably more on the direct motor, probably closer to 3.5%. Same horizon of time, which means for the total market share for China, probably closer to 1%, because we'd be smaller on commercial lines than what we would be on the motor side.
Good afternoon, Pierre Chideville, Crédit Mutuel. Two quick questions. First question regarding the impact in France of the reform of the FGAO on the prices in the P&C business. You have made some estimates regarding this issue. And the next point is we can see, for instance, in France that BPCE has decided not to renew its agreement with CNP regarding the distribution of life insurance. Regarding P&C and also life insurance, what is your view, particularly in Europe, regarding your banking partnership, considering the fact that French, European banking sector is now eager to find some ROE, and that insurance business and integration of insurance business engines could be for them, due to the leverage, double leverage, and after Danish Compromise, a good solution to find ROE, as we can see that all banks now, and particularly in their investor days, are saying that insurance is now one of their priority to find ROE. Are you confident in the future regarding your banking partnership in Europe? Thanks.
Yes, I could have mentioned Crédit Mutuel as a good practice as well for developing bancassurance in terms of penetration rate. I would hand over to Nicolas to comment on the French situation, regulatory evolution vis-à-vis the FGAO, notably in the rest of your question. And I will complement on the rest of the opportunities.
Yeah, good afternoon. So yes, the French motor market is going through some regulatory turmoil. One of them was created last year with a change in the FGAO. The FGAO is a central body depending on the Treasury in France that was created. One of its tasks was to hedge the inflation, to be a hedge on the inflation for the annuities we are paying for people that have been hurt and to whom we are paying an annuity. So the Treasury, French Treasury, decided to end this agreement. So they won't continue, they won't renew for the new casualty this hedge against inflation. So we will have to hedge ourselves. We believe the impact, so it's an impact on the future business, not on the past business, because the past business is remains covered by the FGAO, and we are talking about around 2% of premium. On top of that, we have other type of pleasure. The French government have decided to put the same cover for everywhere in France for bodily injury. So we have the same tariff around France for all the cours d'appel, so the tribunal around France, and there will be an inflation of the cost of claim through that, because bodily injury cost will increase, we believe, between 3 and 5%. So all in all, this will also have an impact on the cost of claim. It has a small impact on the past, because people that were hurt 1 year, 2 years ago, and that didn't see their situation closed yet, will have the new regime, the new tariff applied to them, while and the new one will have the same. So we'll have some change. Some of it will come from reserves. Some of it will come from tariff increase. But what does it mean? It means that the French motor tariff will increase in the coming years, because we will have to absorb these regulatory changes. Thank you.
Which means that this will be something which is against the rest of the trend if we have some increasing this will add to the rest of the trend in terms of frequency that we mentioned, so to push up the prices. So in terms of let's say the loyalty of opportunity of our banking partners, Denis, you want to add something?
Good afternoon. So your question is about the Danish Compromise and the future.
Yeah, my question was, do you feel confident for the next coming years regarding your banking partnership in Europe, considering the fact that the regulatory treatment of insurance for the banking industry in terms of double leverage, but also Danish Compromise, pushes the bank to develop their own insurance business, because it's good for their profitability, as it seems today in their communication, as when we listen to the bank management, they all say that insurance for them is a key point to gain ROEs. And as you know, for the banking industry now, ROEs are very, very low, and they are eagerly searching for ROEs. 50 basis points for them is the sky. I was given the example of Natixis and BPC, but I can tell you that in the next coming months, you will see Crédit Agricole, BNP, SocGen, focusing largely on their insurance business to convince analysts and investors that they are going to gain profitability thanks to insurance.
Okay, this question is a very French-focused question, because when you look across Europe and even beyond, what we have seen in the past is that most banks have decided to sell their insurance businesses and get only fee income commissions from insurance because it was a more appropriate use of their capital to focus on their banking operations. And we have a single market, France, where we have a continued focus of the banks on ownership of insurance companies. This is very much related, in our view, to the Danish Compromise. And the question that investors and commentators are asking now is, how long will the Danish Compromise last in the new European regulatory environment, where all the banks, all the large banks, will be regulated by the in Frankfurt, basically. So, and I have no crystal ball as far as this is concerned, but I can tell you that if you exclude France, we have seen a very positive trend in terms of our bancassurance developments, because all the banks have sold or intend to sell their insurance business to focus on the distribution of insurance products, where they have fee income, commissions, so non-risk income, which is their bread and butter, and which is good for their ratios and the way the analysts, the investors look at the makeup of their profits. So I'm quite confident. So we have not built great hopes as far as bancassurance in France is concerned. We have great hopes as far as bancassurance in the rest of the world, which is almost 80% of AXA's business, is concerned.
If I may just add a word to what Denis has said, it means that in this case, ROE means relying on exception. And building a long-term strategy relying on exception is not something I would see as very, very wise.
Oliver Steele at Deutsche Bank. Just one question about the reinsurance. You said that you'd lifted your excess from 300 million euros to 500 million euros, but you've also issued that cat bond. So what does that mean now in terms of your exposure in the case of a catastrophe? Second question is, how much do you save by that? And third question is, when or how often in the last few years have you seen a catastrophe that's taken you above that previous limit?
So I will start the answer and maybe ask Philippe Derieux, our group reinsurance officer, to complement. First, it just basically means that in case of a natural catastrophe, so far we were retaining 300 million euros for us inside, and now it will go up to 500 million euros. So which means that we are retaining more risk inside our balance sheet and ceding less in terms of premium and in terms of value creation, related value creation to the market. How much we'll gain with this It will be part of our technical margin improvement, doubtlessly, but this will very much depend on what will happen on the natural event side for the future. So this is basically the picture, and we still have some, let's say, conditions to be protected against major events frequency. Do you want Philippe to complement my answer, or are you satisfied with the answer, or did I miss the last part of your question, maybe?
So, maybe one additional point related to our experience. The only year in which we have had, claims in excess of those amounts has been 1999, yes, where we were hit at the end of December with the two storms, Lothar and Martin. So in the recent past, this has been the only situation, and I would say that we believe that the addition of those two events was an event that had a frequency of more 1 in 600 years than 1 in 200 years. That was the view at the time.
And just please.
You didn't answer was when does the cat bond cut in? Sorry, at what point does the cat bond cut in then?
You mean where is it positioned?
Yes.
It's positioned just for the Eurostorm part. That means over 1.5 billion capacity. So that's in a high range of the group cat cover. So not on the lower range, but a higher range. And what we've got as conditions are competitive to the actual. Compared to the actual reinsurance, the traditional market. And on top of that, it gives us the possibility to have a multi-year cover, because the cat bond, the two layers of the cat bond are covers we buy for 3 and 4 years. So that's an addition to that. And on top of that, of course, that's fully collateralized, so that we have no counterparty risk on that.
And just to conclude on this part, we think that the return on equity that we have, the return on capital, on additional capital we need in order to retain this amount of risk inside the group is above 15%. So definitely for us it's a driver in terms of deciding to increase our retention.
Thomas Jacquet, Exane. Last week we had the chance to participate to another very interesting investor day on a business that is growing with combined ratios in the high 70s, which is credit insurance. You're currently not involved in that business, but would you consider any opportunity should an asset come to the market?
No, I think it's not part neither of our core business nor of our peripheral businesses. So it's a different specialty. Even though we said that we will look at new products such as agriculture insurance, for instance, but we'll stick to our business. Have we exhausted the questions? I hope not the audience. So thank you very much for your attention. Thank you very much for your question during this long day, but I hope it was interesting to have this specific focus on property casualty business at AXA. Thank you very much.